A very good morning, everyone, and a very warm welcome to all of you on behalf of the Institute of Chartered Accountants of India. Well, my name is C. Abhilasha Mudgal, and I would like to welcome you all in today's webinar on capital market, which organized by Committee for Members in Industry and Business of the Institute of Chartered Accountants of India. So today we have C. Durgesh Kumar Kabra, sir, Chairman of CMINB of ICAI, our speaker C. Nimish Maheshwari, who will guide us on investment opportunities in capital market. Our next speaker is C. Mohit Base, who will guide us on IPO, a way forward to raise capital. And we have C. Giriraj Ban, who will guide us on equity analysis. So now I am profoundly delighted to take an opportunity to introduce the speaker of session, C. Nimish Maheshwari. Sir is a co-founder of Beat the Street and considered as a trusted voice in the industry. His insights and analysis have been featured in some of India's topmost publications like Economic Times, etc. His YouTube channel is also well known for providing valuable analysis to help the investors to make the investment decisions. Sir, I request you to please light up the session by your compendious knowledge. Please, sir.
Hello, everyone. Thank you so much, Avilasha, for introducing me. Uh, I think let's start with the session directly. Everybody hear me? There's some issue in voice.
Sir, no issue. You can start the session.
Okay. So I'm just sharing my screen so that you can see my presentation. Everybody can see my screen. Avilasha, can you see my screen?
Yes, sir.
Okay. So now let's start with the topic. Okay. Today's topic is about investment in Indian capital market. So, in developing economies like India, there are a lot of opportunities available in the capital market. And here today we are going to discuss about the potential of Indian capital market and how you can, capitalize this opportunity in the developing country like India. So, first of the topic is ki how you can ride on this trend. So there are two or three trends which we can see while investing in the capital markets. It's called like short-term trend, which is which is less than 1 year. Then you can see that there is a some long-term trend which is like more than 1 year, but less than 2 or 3 years. And then comes to the topic is like mega trend. So mega trend are the decadal trends, like changes which is a long-term changes, and the developing countries like India has potential to capitalize these particular changes. So my the whole the investing scenario is the value based scenario, and I want you to understand the potential of the Indian capital market via a trend analysis which is called mega trend investing. So mega trend investing is like, you are capitalizing on a long term changes, and potentially that complete change lead to your long term growth. So अगर हम बात करते हैं like mega trend investing की, then uh, all those changes which is occurring in the economy, like today we are talking about like the last few months we have seen like there are potential changes in the travel industry. There are potential changes in the manufacturing because government is pushing. Like if we see that there are a lot of announcement which is coming in the railway segment also. So there, when there is a long term changes is happening in the particular economy and the businesses, and that lead to long term growth, that is called particularly mega trend. And why I chose a mega trend is because when you invest in a short term or long term trend, that lead to only creation of some penny amount of your wealth. But when if you want to create just wealth, and then if you can invest in the mega trends in particular economy which is developing, then you can ride on the whole journey of a decade, and you can manage, or you can invest and create wealth for yourself as well as your family. So what is mega trend investing then? So this lead to like uncovering, identifying and understanding the forces that completely change the way business operate and consumers behave. So I will also take you the example. Like if you have seen like from 1998 to 2006, if you again see my screen, this chart shows like 1998 to 2006, one example of a leading software company. From if you invest like rupees 2 lakh in the particular Nifty or Sensex in the January 1998, then Nifty or Sensex generate only 7.5 lakh. But if you invested in this particular company, where there's a bull run in 2000 because of the dot com bubble, and then again this company changed. So what happened, what is the change? This is called a mega trend because there are three things which changed in India. So India has a favorable demographics, like इंडिया में बहुत सारे लोग हैं जो इंग्लिश स्पीकिंग पॉपुलेशन है, those who understand the English as well as they can speak English as well. So first thing is that, the another thing is that there is a technology changes. So from 1990 or 2000, Indian government announced IIM IITs in India. And उसके बाद क्या हुआ, there is a huge development in the software category and the technology category, and the Indian CEOs and Indian tech persons are known worldwide for their software development. So the second thing is that there is a huge technology changes which is happening in India. And third is the global delivery model. So before this, there are few models which where they're like, the like chemical processing is happening in like China, then they will deliver this particular chemical to the worldwide. But धीरे धीरे क्या हुआ, that there is a huge changes in the global delivery model, that everybody in the service industry is also shifted towards the global delivery model, like create from one country and then deliver in the whole world because of the internet. Now all these three things change these are all favorable to the India, and India become a hub for software development, and that lead to 60x growth in the particular company. So if you can ride on these particular software development company or software or particular mega trend, then you can generate or create wealth for yourself as well as your family. So the mega trend is like uncovering and identifying these particular changes which change the business, how business operates, and how the consumers think, how the consumers behave. If we talk about like ourselves, like from 2015 onwards, post Geo came into the picture and post UPI, there is huge changes in we have seen in the particular payment industry as well as particular our consumer behavior and how we consume content over the OTT as well as on the mobile. So these are called phenomenal changes. These are called like mega trends which completely change how we think, how we consume content, how we behave, how businesses operate. Because everybody is now wants to go digital, everybody now wants to go on the cloud. Similarly, if you can discover these kind of investment opportunities, then you can invest in like in these kind of mega trend. And mega trend investing should be, and it needs to be the core of investors portfolio so that you can build your wealth. So this is one example of software company from 1998 to 2006. Now if we talk about another industry, which is lending industry. So from 2008, after 2008, what happened is post Lehman Brothers, there are huge changes in the complete payment as well as complete economical changes, like banking system, complete distribution of money via banks as well as RBI, as well as complete you can see the complete ecosystem of the lending mechanism changed because of post Lehman Brothers. Now, what three things which is positive for India? Here we can also see from 2008 to 2018, it's a 10-year period. And if you invested in particular Nifty 50, then you will able to make like from 2 lakh to 3.5 lakh. And if you invested in particular leading retail bank, then you are able to make 5x from this particular period in last 10 years. So what changed here? Now there are three positives here also, like per capita of income increased from $500 to $1,000 from 2008 to 2018. First thing, this change. Then there is a digital banking as well as civil score is announced in India, where the things are changed from like a bank has a complete database of any particular person who wants a loan. So if anybody comes to you or anybody comes to the bank, then they can easily see their score based on the data collected by the government and given to the bank. So uh, there is a potential, you can see that there is a less amount of risk a person or a bank has of you can say that a loan can get into an NPA. Then another thing is the growth in retail as well as consumer credit. So from 2008 onwards, there is a huge changes happened, and everybody wants to ride on the credit cycle. Everybody wants to ride on the capex cycle. So retail and consumer cycle started, and post that there is a huge increase in the lending ecosystem in India. So this will lead to retail private bank as well as NBFC, so that they can ride on that particular thing. And post 2018 or post, and in this scenario also, some of the NBFC, some of the public sector banks started doing, a lot of lending things, which is uh, they are not seeing it properly, and they lead to the more and more NPAs, and there are some banks which go bankrupt also. So you need to ride on the particular theme and particular mega trend, as well as you need to find out a particular company where you can invest and where you can ride the particular mega trend over it. Now the case study 3 is Indian chemical industry. So if you can see that there are again three changes which happened from post 2019 to, if we can say, like April 23, this year onward. So if you have invested in Nifty 50, you will generate like 2 lakh to 3.5 or 3.4 lakh. Where if you have invested in this particular leading chemical company, then you can make, you have potentially made like 12.7 lakhs. So what happened? What are the things which has changed? So here again, the three things like regulatory and policy changes from 2019. If you can see, China has become stringent in terms of the regulatory requirement of the pollution, and that lead to change in the whole Chinese manufacturing, which is Chinese chemical manufacturing, and that lead to resurgence in the manufacturing operations in India, because India has a huge potential, because India has a huge factories, but they are not able to operate because of the dumping from China. But when there are things which change in the China because of the natural, environmental, as well as, there are G20 sustainability, you can say like ESG concerns. So that led to a shift of manufacturing from China to India. Again, then there is a regulatory and policy changes from the government side also, where there are a lot of licenses which is required earlier, and there is a lot of red tapeism in the whole ecosystem. From post, you can say like 2015, 2016, there is a lot regulation change. There is a ease of doing business in India, and then global companies also thinking about India as a sourcing partner. They want to go like China plus one, so that they are not dependent on only one thing, and that lead to huge opportunity in Indian chemical industry. As well as I am still betting on this particular chemical theme, because India has a huge potential. There is a huge bandwidth available, as well as India has a young entrepreneurs, where they can particularly ride on these particular trends, ride on particular industry, and they can generate a huge amount of returns here. Now why to invest in India? There are three things in the past which accelerated India significantly, which I want to highlight. Is first is Geo. So if you can see this chart, this is presented by Finshot, and this shows how much does 1 GB of mobile data cross the world. And you can see that India is on the lowest, one of the lowest country in terms of data, and so data cost. And we are able to make, we have a 1 GB in just $0.68, and that lead to our data consumption 15 times, because just cost fell from, like, cost fell by 90%. So per GB consumption, per GB, if we can say that per GB internet data costs are just 3% in the US. So if US has like $1, just we are doing it in 3 cent. So $35 billion bet made by a private individual, or Mr. Mukesh Ambani, to make India data rich. and that lead to a complete change in the whole country. If we are talking about Ola, if we are talking about Uber in India, if we are talking about Zomato, if we are talking about Policy Bazaar, every startup, every company is based on the digital platform. Even OTTs, if we are seeing like Sony Live, Geo Cinema, the base of every new company which is coming is on the digital and the mobile base. So from when this particular individual from 2016, when the data becomes so cheaper, the consumption of even YouTube is becoming so high that now everybody or anybody wants to become YouTuber, because the consumption of data increased significantly, and India is a huge consumer of, if you can say, uh, social media. We are number one in the Facebook consumption of data. We are number one in YouTube. So things changed post, these significant things. This significant thing happened, which is Geo. Then the penetration of smartphone is also increased in India over the period. Now Apple also invested heavily in India to make iPhones in India. So these are things which change because of the whole ecosystem is changing. Like how Geo exploded the whole universal metric in startup valuation because of the total addressable market, which is TAM, which increased. Because like अगर पहले अगर 100 लोग यूज करते थे इंडिया में, 1000 लोग थे और 100 लोग मोबाइल यूज करते थे, आज इंडिया में वो 500 से 600 और 700 तक पहुंच चुके हैं, एंड नाउ इट इंक्रीजिंग exponentially. So the things are changed, like because पहले क्या होता था कि low productivity, e-commerce, everything is because क्योंकि there is only 4 or 5 cities which is giving you the total addressable market. But post Geo, everybody is using mobile phone, so everybody is a customer, and everybody is a customer. Then it will increase your addressable market. It will increase the size of the market, and that will provide entrepreneurs, employees, consumers, the whole big market, and that's where the India changed significantly. Again, the another thing is UPI, which is a digital payment gateway system, which is created by NPCI. And now, what this change? This is the real time, low cost, and open architecture. So real time is like you just need to press 4 digit and the payment is done. It's as secure as RTGS NEFT. It's more secure than RTGS NEFT. It's a low cost, so you don't need to pay anything. You just need to from like last 6 month, Paytm and PhonePe start charging convenience fees. Before this, there is a low cost. There is zero cost of particular UPI uses. Then this is an open architecture, so anybody and everybody can use it, and you can take a base of it, so that any application wants to use the UPI architecture, they can use it. So this thing created, and this thing changed the every like if you are talking about Zerodha now, that Zerodha ki profitability is like 3000 crore. But the things changed when the Indian government or SEBI announced the system that you can use UPI to add money. Before this, you need to RTGS, NEFT. So there is a lot of time gap involved in that particular thing. And your particular thesis or your particular theme, if you want to go for intraday trading, and if you want to invest particular thing, but आपके वो पैसा बैंक में पड़ा हुआ है, तो आपको this take a lot of time to invest in particular to come out with the things. And just payment के लिए अगर आपका कोई काम रुक रहा है, then it created a whole lot of hustle and bustle in your mind as well. So now if we are talking about Indian potential, then like from 2020 you can see that the volume increased from 12.45 billion to 84 billion. So there is a 7 times increase in the volume, as well as there is a 7 times increase in the value as well, from 20 trillion rupees to 140 trillion rupees. And everybody in India, if you can see, like auto walas also using, dibba walas also using, everybody wants to use, even the street vendors also using the UPI. And the whole UPI changed the thinking of the India, that now uh, uh, like from last 2 months, 3 months, I have not used credit card even, because it's so simple to use UPI, so that nobody is thinking about even using credit card, which is giving you a 1 month free credit. So these are the things which changed the whole ecosystem and the whole things in India from from last if we talk about the last 5 years, last 6 years. Now the another thing is the Aadhaar based India stake. So India created a unique identity for each and every individual in India, and that is called Aadhaar. And Aadhaar changed the whole ecosystem, because everybody or everything which is driven by government and which is linked to government, and anybody wants to verify something, then they can use Aadhaar based India stake, and that's created a whole the 140 crore individual at a one line. Everybody, anybody wants to do start anything and they want a verification, then Aadhaar is the only thing. Before this, what is happening is every industry wants a some healthcare department is some healthcare department is using something different identity. Your Aadhaar, your ITR filing is using your PAN card. So there are different identity for each person, and that is and the people are misusing the particular identity. Now after Aadhaar, the wrong things becoming less and less, and India becoming more, you can say more, the think about the more individual identity, and the Aadhaar becoming the framework which helped India in creating the UPI, as well as in creating the whole uh, whole whole population at one sentence and one line. Now the UPI, that if we talk about, like Google is writing later to the Federal Reserve, that one we need to implement like how India implemented the UPI, because even if you see like Singapore and Nepal, these are countries which started using UPI, and UPI is becoming global. This is the thing which also attract people's mind, that UPI, which is created by Nandan Nilekani, created in India, created by individuals sitting in India, is now going global, and everybody wants to use UPI to create faster transactions. So this is the second thing which changed the India completely. Now the another trend is GST collection trend, which changed the India, and which created India, and now this is also increasing day by day, and which is showing that how India is growing. Like indirect tax, if we talk about, there are a lot of taxes before GST, and post GST. Things changed, because there is only two law, CGST, SGST, and IGST. There is a three law, just three law, and everybody now bind by the ecosystem of the government, which is driven by Central Council of GST. What changed after GST is now people started, the people before this, people are not abiding by the law. They don't want to use particular system. But when everybody is into GST, then they need to go into, and they need to take the GST license, and everything is driven by the law. So you need to take the license, you need to take the particular registration of the GST, and this will lead to the formalization of the economy. This will lead to the economic cycle is rising in India, and GST become the backbone of this. GST incentivize the law abiding supply as well as distribution chains, क्योंकि पहले जो GST, पहले आधे लोग बिल देते ही नहीं थे GST का या इनडायरेक्ट टैक्स का. नाउ एवरीबडी वांट्स टू टेक, बिकॉज अगर उनको क्रेडिट चाहिए तो उनको लेना पड़ेगा GST का बिल. एंड नाउ एवरीबडी एंड एनीबडी जिसको भी इंसेंटिव लेना है, लाइक आपको क्रेडिट लेना है, यू नीड टू टेक द GST bill, so that and it's created the whole circle where everybody who is using GST is incentivized, and the whole supply and distribution channel is formalized after introduction of GST. So if we can see the GST collection trends from April 2022, so the yellow line is April 22, and the gray line is April 23. So if we can see that there is a uh, increase year on year basis. If you can see from April, if you see 1,67,540 crore collection from by the government, where if we see in July also there is a huge amount, huge increase in the GST collection, and it is increasing day by day. Even UPI transactions are increasing day by day, and that is showing that how India is growing, how these changes, these mega trends change the Indian economy completely. Now we talk about what are the three things which accelerated India in the last 6 to 7 years. Now we are talking about, like, if you are ask me, like, how one can find the mega trends. So there is an acronym of TRE&DS, trends. So T stands for technological. India is, if we are talking about the technological perspective, India is way ahead because of, like, in India, there is one company, one leading technology company, which have market cap more than even the market cap of the complete Pakistan Stock Exchange. And that's where there are a lot of innovation which is happening in India. There are a lot of tech revolution which is happening in India. If we can say, the whole UPI is based on the technological interface. The unified payment interface is particularly the backbone of the digital economy of India. And you can see that the transactions are increasing, which we already talked. And there is a potential that this will increase from 2021 to 2026 by 5 times, which is a whole which is a very very big amount, or very very big numbers, because everybody wants to use UPI, and that lead to formalization of the whole ecosystem, which is using the cash economy, which is the cash economy or the cash ecosystem, which is changing. And now everybody wants transaction based, everything is recorded, and that's where the formalization of the economy start. The another thing which is changing is the regulatory changes. The Indian government is pushing towards creating regulation around Indian manufacturing, as well as creation or ease of doing business, as well as creating ecosystem of the regulation which helps businesses to grow, rather than pushing them down. They have a capital outlay from the government as well as private individuals, that lead to potential revenue of $455 billion, if we are talking about just PLI scheme. So there is a capital outlay by government of $33 billion, that lead to potential revenue upside of $455 billion in the upcoming 5 to 6 years. And that's where the things are, like, how our government is thinking that creating the ecosystem that lead to increase in revenue from, like, 33 from just investing 33 billion to create a revenue potential of $455 billion, and becoming India more an export economy rather than an import economy. So there are a lot of things which is changed, like, if we are talking about the biodiesel, which recently has been in a trending section because of the G20 summit. Then we want, our government want to reduce the consumption of the crude, so that there is a huge there was a lot of changes which is happening. Like, if we are talking about the ethanol consumption, government wants to create an the flexi fuel motor vehicles, flexi fuel the cars, so that more and more ethanol which can be used, because India is a ethanol positive economy. It's not where that we need to buy ethanol from outside India. We have a surplus production of the sugar cane, and from sugar cane we can make ethanol, as well as we have a bunch of we have a agriculture rich economy. So agriculture may there is a there's a waste which can be also converted into the biofuel, and which can be also used in the automobile, as well as consumption and creation of energy. So Indian government has formalizing this particular system. They are creating the biofuel alliances with the other growing economies, and that's where the potential of the Indian economy you can see. The another trend is the economic trend, which is the financialization of economy, which we have already talked about. UPI, as well as the transactions which is happening and documented. So now everybody wants to document, because Indian government created a whole ecosystem. Even if we're talking about the regulatory things, even if we are talking about, like, growing formalization in the economy via GST, via UPI. So these are things which is creating the formalization, and everything is documented. So nobody can think about thinking about, like, मैं अगर 500 रुपये बचा लेता हूँ तो मेरे को यहाँ पे बहुत फायदा हो जाएगा. नाउ पीपल आर स्टार्टेड थिंकिंग अबाउट कि अगर पैसा कमाना है तो टैक्स देना पड़ेगा, एंड टैक्स दो, आप और ज्यादा पैसा कमाओ. पहले क्या होता था, पहले पहले पैसा पहले हम सोचते थे कि टैक्स बचाएं फिर हम कमाने की सोचेंगे. नाउ एवरीबody स्टार्टेड थिंकिंग धीरे धीरे कि नाउ लेट्स फर्स्ट मेक मनी, गिव टू गवर्नमेंट एज अ टैक्स, देन again make money. So this is something which is called financialization of economy. Now the another thing which is changes in economics is infrastructure boom. So if we are talking about railway infrastructure, road infrastructure, as well as creation of the ports, everything is changed from, if we are talking about last 5 to 6 years, there is a huge bump in the infrastructure, and Indian government is pushing towards infrastructure, and that's where also there are a huge potential in the infrastructure sector where you can invest and create a huge amount of returns. As well as consumerism and urbanization is increasing. Everybody wants to have a higher lifestyle. Everybody wants to use the premium products. Premiumization is becoming a trend. Nobody wants to, like if we are talking of an example, nobody wants to ride on the Alto. Everybody wants to go on the higher and higher and higher side. Because of the per capita income is also increasing, the complete consumerism as well as urbanization is also happening, and that's lead to a premiumization trend. And premiumization is also increasing because it's an ecosystem, and once your capital income is increased, you will invest more as well as you will spend more, and that will increase the GDP of India completely. Now another thing which is changed is nature. So in India, not only in India, even China as well as other economies also thinking about the nature as well as green potential of any economy. We are more focused towards solar ecosystem, we are more focused towards wind energy, biofuel, so that uh, uh, we rather than using the crude as well as that is hurting our complete environment. We need to focus on more on the green side of the economy, so that we have a sustainability. India is also pushing towards EV production, so there is a huge potential in EV companies, those companies which are creating EVs. So there is a potential, like from India's EV production, if we see from FY21, which is zero point 0.6 million units, now it can increase to 16.9 million, which is a 28x increase. Recently, if you have heard that there is a huge order booking from the government side also of the EV buses, and you can see that there is a huge change. We can see in the government philosophy as well, that even government wants to push towards solar. They are giving subsidies, they are giving they are giving a free spaces. Even if we are talking about the state government and the central government, they want to push so that we can become an energy transition country, where we can drive the growth from crude oil to become a solar based economy. Now the another thing which is demographic dividend, which is positive for India, like there is a huge potential in the Indian young, which is a country which have a high amount of youth, and they have a huge potential in creating uh, the new era of entrepreneurship, where they can facilitate new things. And that's where also we have an edge in terms of demographic dividend. Anybody who wants to start new business, there is a huge big market which is available in India, and we also have potential to penetrate the world market as well. The last thing is where you can find the trend is the social, which is the rising consumerism and urbanization, which I already explained. So these are acronym which where you can find the mega trends. So that's a very simple thing. You need to always think about that, like technological changes. Any company which is focusing on the technology, regulatory or manufacturing side, economy, which is like financialization of economy. Our SIP book, uh, the complete Indian SIP book is becoming 15,000 crores. So every month, our people are putting $2 billion in just SIP, in just mutual fund businesses. So you can see there is a huge potential in the mutual fund industry, as well as huge potential in the complete financialization of the economy, that you can make enough amount of return over the particular riding on just one trend. Like if we are talking about the mutual funds, there is a huge there are a lot of AMCs which is available. There are a lot of companies which is giving them back end, like KFintech, camps. There are a lot of companies which is available in the particular segment. If we are talking about infrastructure boom, there are a lot of government companies, as well as there are a lot of private companies which is creating and helping. Like recently JSW Infra IPO came, and this is, but if you want to ride on the port businesses, you can just invest in that particular. So if you are thinking like investing in India, you need to catch particular trend where you find that there is a huge amount of money where you can make the money, and you can find that this is particular mega trend which is happening in India. Then you can definitely make a huge amount of wealth for you. uh, if we are talking about the nature, there are a lot of companies which is creating solar panels, which is in the wind energy. Demographic mein already this is a positive trend which is happening, which is why we are driving for our startups, which why we are driving for the manufacturing, as well as health and wellness focus. There is a huge potential in India to create a health economy, because health tourism is a trend in the whole world. Everybody wants to operate themselves where this is where the health ecosystem is good, as well as the cheap. And India has a huge potential to ride on this particular trend. So these are things which is helping India in growing. And these are the mega trends which where you can ride on, and you can make a wealth for yourself. Now this is the mega trend. Now if you are asking me like what is the process of mega trend investing, how one can invest in particular mega trend, what and how you need to think post finding the mega trend. So first of the thing is the strategic vision. You need to think from the perspective of what are the long term shift which is happening in particular theme, what are the potential of the revenue and the potential of profits of the particular theme, particular companies. Then you need to identify this from the six sources, like whether macroeconomic changes are happening in or not in the particular industry, like chemical industry. What are the changes in the regulatory terms? What are the technological changes which is happening in the particular industry? What are the societal changes, whether the society is accepting on or not, whether government is pushing it or not. Like if we are talking about the gaming industry, there is a huge red flag, because there are a lot of penalties are there. If we are talking about the fantasy sports, there is no clarity of the law as of now. So these are the trends which you need to find, because if you want to invest and you want to ride on the wealth creation industry, wealth creation, then you need to focus on these kind of the macro changes, like what are the environmental trends in the particular industry. If we are want to ride on the consumption trend, whether the particular company is complying the environmental laws or not, whether if we are importing something or exporting something. Like if we are talking about textile businesses, so there are a huge geopolitical correlation in the particular industry, and the whole cycle revolve around the geopolitics. Because if we are able to sign a UK FTA, which is the free trade agreement with the UK, then we can also sell our yarn as well as fabric to the UK government or the UK economy at a similar price, which where the China and the Bangladesh and the Vietnam is selling. So there is a huge potential after when we are able to sign the UK FTA. So these are the trends which you need to find out, so that you can ride on that particular trend over the longer period of time. And there is a huge shift in the consumer as well as the production behavior. So these are six sources where you can analyze that particular company, that yeah, this is the one where we can invest. Then we need to find out the sector impact, whether this is in the direct or derivative influences that the particular company. Like if we are talking about the financialization of economy, like everybody wants to invest in the capital market, everybody wants to do mutual fund. So we need to invest in the company which are providing mutual fund. Now you need to you can also invest directly in these companies, as well as you can also have a derivative influences also. Like anybody who is supplying to these companies, you can also invest in that particular company. As well as you can also think like if you are thinking like consumer vehicle industry, commercial vehicle industry is growing in the next decade. So because of the because of the government push that you need to change the vehicle, and you need to test this particular after some point of time, like 10 years or 20 years down the line, then you can ride on the industry in a two way. One is you can directly invest in the companies where what they are or manufacturer of the commercial vehicle, and the another is the derivative influences, which is the proxy companies, like any company which is also giving them product, like Excel, like wheels, like tire industry. So if you want to ride on particular theme or particular mega trend, it's not necessary that you can invest directly in that company which is creating that. You can also invest in the derivative of that particular theme also, and this is called a proxy investing. So if you want to ride on the auto cycle, you are riding on the auto ancillary, that is called the proxy investing of auto cycle. The another is the beneficiary focus. You need to identify that from these particular trends, what are the companies which is able to support this particular trend as well as capitalize this particular trend, because there are a lot of companies. Like if we are talking about ethanol, there are a lot of companies in the sugar industry, but nobody it's a complete trend, it's a complete game changer, but some of the promoters are able to ride on that, and some of the promoters will left aside, and they can even go for bankruptcy. So you need to find out that particular beneficiary, that you need to find out that particular companies that can support these trends as well as gain from these trends. Then the last one is the diversification of growth. So if you want to ride from the future growth, diversify your list of businesses where you want to invest. It's not like आपने financialization है, या you want to ride on the commercial vehicle, just invest in one particular company. You need to diversify your portfolio so that even if one trend is not going in the direction where you are thinking, but in another companies will help you in terms of creating your wealth. Now, if you are talking about the four megatrends which is upcoming which is for upcoming decade, there are four megatrends which I think has a potential of becoming a megatrend in the upcoming future, which is the financialization of economy, where mutual fund AMCs, broking companies can ride on that particular, because India has a very less amount of people which invest in the particular capital market. So we are on the cusp of growth in the particular theme of financialization. Another is the manufacturing. China plus one theory as well as Indian government push of PLI will help India grow in terms of manufacturing sector, and manufacturing sector will become, I think, has a huge potential to grow as well as to export from the India. Already, if you can see that iPhone 15 is made from India. The third thing is consumption. So whenever there is a increase in manufacturing, increase in per capita, or increasing in financialization, that in turn help any economy in increasing their consumption, and that's where the third trends come into the picture. And the energy transition, which is the ESG theory, as well as ethanol, biofuel, solar module manufacturing, as well as wind energy. So these are energy transition from fossil fuel to non-fossil fuel, will also help India to become a positive in terms of positive energy economy, where they can export even energy from India and become a export hub, not only of services but also from for the products as well as for the energy as well. Now, after identifying the mega trends, how to assess, if you are able to find out there are two or three companies, then how to assess that this one company you need to or you want to ride on. So there is a three filters which you can use: is the monetization ability of the promoter, monetization ability of uh, the the particular entrepreneur. So if you want to invest in a startup, or if you want to invest in a capital market, so you need to find out that these are the companies and these are the promoters which can ride on this particular growth. They are telling about the growth, and they want to ride on this particular trend. and how they are planning, how what are their potential, what are their customers, how they are treating their customer, what are their customer product and services, how their margins are growing, whether their user base is growing or not, their profits are also increasing or not. So these are things you need to identify in the first filter. Then the financial due diligence, that whether the company is making a cash flow or not, whether their balance sheet is healthy or not, their capital intensity, their capital allocation is proper or not, their revenue growth is strong, the trends and the revenue growth and the trends are positive or not. They are more focusing on the sustainability initiatives, constant. They are not just focused on the fundraising, that they just want to create valuation, and they're not like just startup which are just focusing on the valuation rather than creating businesses. You need to identify those businesses. You need to identify, even in the unlisted market there is a huge potential where you can invest, even in the pre-ipo segment, ipo segment. There is a huge potential Indian market has to invest in the particular trend. Then the third thing is valuation assessment, which is what I think, why what I say is, you can read the businesses a lot so that you can understand that when to invest, because that is also a very big thing, that you need to identify the valuation assessment, whether at this price particular stock or particular, even in the unlisted market, whether at this valuation this is sustainable or not. Because there are a lot of lot of opportunity cost available with it. If you are investing in just particular one thing, you are you are letting go other opportunities, which can potentially give you better returns. So you need to always assess whether this valuation making sense to you or not. So the valuation assessment is a very big thing, and you need to learn it by the experience only. So the market pricing and the expectation and the market sentiment, you need to focus, and the valuation guide you about the entry and exit in the particular decision, as well as your portfolio allocation. And you will the valuation trend will help you in the portfolio allocation. So these are three things where you can crystallize your thoughts, as well as you can come out with the one company in particular trend, mega trend, to another company is another particular trend, and like you can create your portfolio from this. So these are this is the potential an Indian economy has. So to summarize everything, I just want to create that India has a huge potential in terms of technological development, demographical development, as well as the energy transition development. So there are a lot of sectors which can become mega trend in upcoming times, on upcoming decades. And if you want to ride on this, there are a lot of options available, where you can invest from the, like, in the secondary market, primary market, as well as you can invest in the unlisted market. You can invest even in the startups. So there is a huge bunch of huge bunch of entrepreneurs available, huge bunch of money is available. So if you want to ride on these particular mega trends, you need to invest and ride on this for a longer times to create wealth for yourself. This is my platform where I provide. We have more than 60,000 plus subscribers. We have Telegram channel where you can find a news feed directly tracks all the stock markets. Where we have a Twitter where you can find forensic corporate governance analysis. YouTube already, Abhilasha told about that, we have a deep dives available. You can find out our LinkedIn, Instagram as well. You can scan the QR code as well, where we provide on the secondary market, where we provide a lot of information. So you can write on the particular information if you want to. So this is from my side. If you have any question left, let me know so I can take.
So we have some questions from participants. First, are railway stocks in mega trend? If yes, then what stocks should one look at?
So yeah, definitely. If you can see, like, defense as well as railway, there is a huge amount of potential in the particular segments. And if you can ride on, like, there are a lot of stock, a lot of option available. I don't want to go stock specific, but there are a lot of option available, like railway financing. You have IRFC, in terms of the wagon manufacturing. You have Jupiter Wagon, you have Texmaco Rail, you have other. There are a lot of companies available, but you need to always assess the valuation to identify and to entry and exit.
Sir, what about EV space, mega trend in EV space?
So I have two thoughts in the EV segment. If we are talking about there is a definitely there is a possibility of huge EV manufacturing in India. Ola is already doing, Tata is already doing in terms of Ola is two wheelers and Tata in the four wheelers. But the thing is where I have a disconnect is if we are able to maintain, if we are able to make green hydrogen at a at a particular price, like Mukesh Ambani is talking about $1 for 1 kilogram. So if we are able to make that particular thing happen, then there's a huge potential in the green hydrogen also, green hydrogen and ethanol also. So I don't think that the EV will only option, but EV is the option. EV is not the only option, but EV is the option.
Okay, sir. Sir, one more question. Who will benefit more from PLI scheme, Dixon or Embed?
Again, I don't want to go stock specific, but the whole there are a lot of companies available in the PLI mein. But I think the potential of electronic manufacturing is definitely increasing. Both Dixon and Ember will benefit from PLI, and there is a huge amount of potential which chemical industry has. So chemical industry will go like, in the next 2 to 3 years or next 5 years, they will, if they are able to capitalize the particular trend, then they can become like multi-baggers.
We are not getting more queries. Can we move forward for next session, sir?
Yeah, thank you so much, Abhilasha.
Thank you. Thank you so much, sir. So now we have our next speaker, CA Mohit Basir, who will guide us on IPO. Sir is a qualified in 2012 and having 10 years of experience in equity capital market. He is associated with reputed investment bank and have multiple prominent capital market transactions across the sector. He is also nominated member of Financial Market and Investor Protection Committee of WIRC of ICAI. Sir, I request you to please enlighten us by your profound knowledge. Please, Mohit, sir.
Sure. Thank you, Abhilasha. Thanks for the introduction. So I'll just share my screen for the presentation that we have. Yeah, are you all able to see my screen?
Yes, sir, it's visible.
Yeah. Thank you, Nimish, for enlightening us with the opportunity that are currently prevalent in the IPO market, equity market as a whole. I just want to take one point from what Nimish said. How companies are changing towards, their approach towards paying taxes and earning more, paying taxes, and then, getting better valuations. This is what we see when we see companies going for IPOs. Everybody earlier, the thought process was to, just save tax. When you would, the companies will prepare their financials, they will try as much as tax they can save. But the thought process has changed. Everybody wants to now look at better valuations. And to look at better valuation, you need to first show the results. And to show the results, you need to improve your balance sheets. And there is no other way around by showing how much money that you earn more and how much taxes that you paid. As an investor or as a merchant banker, when everybody goes out to evaluate companies, the first thing that they look at is the bottom line, how much taxes that they paid. And that probably summarizes the importance of why anyone or any company should go for an IPO, which is again the topic for this session. I have tried to summarize my thoughts on IPOs, and we'll probably go in the presentation. There are 4 major parts. The first couple of slides, I'll try to explain why an IPO is important and why it's the way forward to raise capital. The next few slides, I'll try to explain, who are the companies who can go for an IPO? What are the eligibility criteria around IPO? Next few slides, we'll talk about the process, the key intermediaries involved in an IPO, and then of course the balance, key consideration that we can, I can explain those key terms that you might hear in a normal course or a normal course of discussions when around IPO. So I'll start from why a company should be doing an IPO and why it is a way forward for you to raise capital. Okay, so that's the first question when it will come in the minds of a promoter of the company, or let's say the key stakeholders of the company, why we should do an IPO at all. And as of course it goes, the first term which is associated with doing an IPO is finance or money, right? When you're going for an IPO, the first thought would be, do we get money to the promoter's pocket, or does the company get money? So when you're doing an IPO, what it makes company get is the money, and the money can come in two forms. So there are two types of IPO which happens in India. One is a fresh issue and one is offer for sale. When you're doing a fresh issue, the money directly comes to the company, and we are doing an offer for sale. The money goes to the existing shareholders' pocket. On the finance part, I'll focus on the fresh issue because it's the company who is doing an IPO and they're getting the money. IPO helps companies to raise finance for whatever objects that they are aiming for. For an IPO, you have to prepare an offer document, and you will have to explain to the investors what are the objects that you are raising the money for. And probably, other than our traditional source of financing, like, you can go to your banking channels, but everywhere you need more collateral, right? There is a limitation to the traditional source of financing for companies, whether you are issuing debentures, whether you are going to banks, there is a limit. IPO probably, takes you beyond those limits, and hence it is now in limelight, or probably, again, as I said, it's a way forward to raise capital. You can raise capital for any of your objects. You can raise money from IPO for your working capital. You can raise money for your capital expansions. You can raise money to repay your debt. You can raise money for brand building. You can raise money for further acquisitions. If you see a lot of offer documents of IPO, you will see these kind of various objects that you have. You of course need to explain how you are going to utilize that money, through those objects of the offer. But there are various reasons that you can do an IPO for and get that money. How it helps is, as I said, one of the objects can be your repayment of your banking facilities, the higher interest paying debt. It also the finances that you raise, and it's not just financing, maybe it's just the refinance. You can, once you do an IPO and raise money, you can do it again. You can do a further public offer, you can do a qualified institutional placement. And raising money from an IPO not only helps you maybe repaying your debt, but even if you, let's say, you're not repaying the debt through your IPO, okay, or the IPO money, it helps you even your on the present banking facilities. When you go to bank, you make a loan application. There are certain criteria that you need to take. Your loan application is then assessed by the bank depending upon your company structure. You are a private limited company, you are a public limited company, you are a publicly listed company. Whether you have already applied for loan, etc. The number that you take in that IPO, the loan application money, helps you getting the advantage while even negotiating with the banks. So it's not just that you get money from IPO, but the IPO money that you get, it helps you on the current money that you have from even your current banking facilities. And of course, as I said, it opens up the new fundraising options to meet the future expansions. You've done an IPO, you've raised the funds, you've utilized those funds. If you have utilized those funds in the better way or the way that you explain to investors, you gain the investor confidence. A lot of companies that we see, come up with an IPO, next 1 year, 2 years, utilize that money very efficiently, gains the investor confidence, and go for another round of fundraising. That could be through, as I said, further public offer. That can be through your qualified institutional placement. You can raise funds through a rights issue. You can raise funds through a preferential allotment to various investors. The other a key consideration for an IPO or a benefit of an IPO is your employee compensation. Any company, if you see in today's world, we all are probably facing challenges on better human resources. If you are going for an IPO, that does not only helps the employees gaining confidence or feeling related with company. Of course, raising the money is probably the first and foremost reason for doing an IPO. But then there are these qualitative reasons why a company should go for an IPO, and it helps. And employee compensation is one of them. We have seen a lot of cases where employees post IPO have made fortunes through IPOs. We have heard DMart stories. We have heard a lot of them. So the power of ESOPs can only be utilized when you have a company which is listed, or there's a market for those ESOP. We see, of course, there are secondary market for unlisted shares, but that can be very unpredictable. We have seen the case of Reliance Retail, where now there is a buyback or a reduction in capital, and the unlisted market has gone haywire on Reliance Retail, which does not happen in primary market once you're listed. So IPO fundraising helps you unlock the power of ESOP. Your employees feel more like co-owners, right? They hold ESOPs. Everybody is motivated to work harder for the company, because if the value of the company goes up, their value of their ESOP goes up. And of course, it helps companies to attract and retain more employees. We face a day-to-day challenges to attract and get better human resources. If your company is listed, if you have ESOPs plans in place, of course, it becomes a good negotiation point for you to attract and hire better resources than your competitor who's probably not listed and doesn't have the power of ESOP with them. The other key point or point of consideration for companies to do an IPO, of course, is a visibility or a brand building. I'm sure all of you must be aware about SME IPOs. There are two kinds of IPOs which happen in India generally. There are main board IPOs, as we call them, which are SEBI approved, and then there are SME IPOs which are approved by stock exchanges. Those are smaller IPOs in size, quick processes which happens on IPO. SME IPOs has started happening since last 10 years. This was approved by Ministry of Finance in August 2012, when the first IPO happened in November 2012. And then there is a boom in SME IPO. Last 3 years have been very good for SME IPO. Why I'm bringing that SME IPO point here on the point of visibility and brand building is through those SME IPOs. If you see in today's world, we know a lot of companies which we probably would not have heard of if there was no SME IPO tool, and if those companies didn't choose for the SME IPO. They chose for an SME IPO, and that IPO brought them to the stock exchanges, and it opened up it opened the whole world to them. Not just the world of capital, which is of course again the primary reason for coming in IPO, but the brand building, the visibility those companies have had through SME IPO, okay, is exponential and huge, which is again one of the key reasons why a company should go for an IPO is the visibility and brand building. A lot of SME companies that you would have seen have done wonderfully well even after their SME IPO. It's because as an investor or as a person sitting probably somewhere in Jaipur or Ranchi or smaller towns, we would not have heard about those companies. And as an investor community, people would not have got chance to invest in those companies if not for that smaller IPO and the visibility that they got. We have even seen in IPOs now, even for smaller companies which comes with an IPO, the investors are directly going uh, and they are reaching out the promoters of the company to understand their companies, which is the second point. If you see on the presentation in the visibility and brand building, the companies become first the company used to go to the investors, and now the companies are becoming the sought after. The investor community are reaching out directly to individual promoters who are doing SME IPOs or IPOs. They're trying to understand the companies. They are trying to find their, the reasons to invest in those companies. Again, all because of the visibility that they got, all because of the brand that they're creating through the smaller businesses. And again, let's take an example of Dixon Technologies. It's a mainboard company. They did an IPO in 2016. Most of us would not have heard about that company uh, doing wonderfully well on contract manufacturing for most of bigger brands. At that point of time when they were doing, when they did an IPO in 2016, they were only doing washing machines, TV, and LED. Post that, of course, Make in India came. The ease of manufacturing came. They partnered with Flipkart after the IPO. They started manufacturing washing machines for Samsung. They started manufacturing mobile phones, and probably I think some of one of the participants asked the question on Dixon or Amber to Nimish about the investing. I was lucky enough to be part of that IPO, and I've seen that company in 2016 or 2015. From nowhere, nobody recognizing that company, to the behemoth it has become in last 7 years of listing. Again, all because they did an IPO. Of course, their private equity investors got then exit. The company got some money from an IPO, but the visibility that they got within government across the world, and what they are contract manufacturing right now, even within the contract manufacturing space of low margins, they are doing great. They've made um, uh, a very huge wealth for the investors. And as I said, ESOP, a lot of employees of Dixon, they made a really, really good wealth for them through ESOP. And they've been retained by the company, which again, the second point that I was raising, why a company should go for an IPO. I've seen that company very closely since I was part of that IPO in my earlier capacity. And as I said, it has created goodwill for the stakeholders, not just for company, but also the private equity investor who got exit, the employees, and all the stakeholders of the company. And then, of course, it opened the new market for the company. Okay, so again, this is the second slide on why a company should be doing an IPO. Is the next point on this is exit to current investors. So I raised the point on Dixon. Motilal P was an private equity investor in the company, and they got an exit through that IPO. One of the IPO, again, I was part of was TeamLease Services in 2015. The private equity players got an exit through an IPO. Why it helps companies probably, getting the current investors. So okay, let me probably take a step back and go to who are those current investors. Most of these companies on main board IPOs, we will see a lot of offer for sale, where we see a lot of PE investor, VC investor who invested very early in the company. It is one sec. Sorry. So if you see a lot of IPOs happening today, offered for sale, a lot of PE investor, VC investor getting exit. These investors invested in these companies at a very early stage, and then they are now making exit. And how it helps, somebody you might have a question. An investor is getting an exit, a PE player is getting an exit through IPO. How it is beneficial to company, or I'm paying for that investor to get an exit. Okay, but it's not just that plain and simple. Once that PE investor goes out of the company, okay, the company probably, or the promoter, retains their control. The investor came because they believed in the company's vision. They believed in the company promoters. They believed in the idea of the company, right? And they invested. Every PE investor or VC investor has a timeline to their funds, or their vision to make money on their investment. They have made their enough money. That doesn't mean that company will not make money in the future. They will continue to make money, but all these investors will stay with the company for a time period. Let's say it could be 5 years or 10 years, and they bring their own perspective to that company. Company has to report on a monthly or a daily basis to these investors with a lot of MIS. So a lot of time of management or the company employees goes into feeding those investors with the information that they require on a monthly to monthly basis, or it could be quarterly, fortnightly, or yearly. Company gets out of that loop. The perspective that those investors brought on, they would have brought their nominee directors on board. Company gets exit from all of that. Now the focus of the promoter, if the private equity investor goes out, is solely on his business and the next growth. They have grown with the private equity investors. Now they have to take another leap and think about more from the global investor pool. So exit to current investor, while it might not sound good, but it actually helps company. One of the company that I did an IPO for in 2015, I can't name it, but their first and foremost reason for doing an IPO was to get the private equity investors out of the company. They had enough of the private equity investors. They wanted them to take an exit and bring new investor pool, which could be public investors at large. It could be FIAs who invest in public listed companies. It could be domestic mutual funds, so that there is a fresh perspective from the investor mindset also, which helps companies or the promoter from that idea. They named their IPO project as a Poon Swaraj because they wanted a freedom from those private equity investors. And of course, it's good for the current investors to also get exit and make some money. So that could be one reason where if any of you who are listening has a company, has a private equity investors, their exit can help you out. May not be we cannot see it on a plain paper. That's why it will help. It will help you bring the new ideas on. Again, one of the next point on valuation is very important. Sitting on an unlisted market, you can never have the benefit of the valuation magic that you can have on the public market. We have seen cases of DMart. We have seen a lot of these cases where companies have made a huge amount of wealth for not just investors, but or the public investors, even for the promoters. I call it, very fondly, when I go and meet people for IPOs, and I ask promoters why they want to do an IPO. And when they ask me a question in turn, that, you tell us why we should do an IPO, and I fondly tell them, if you want to create wealth, you can continue doing this business the way you are doing it. But if you want to create a generational wealth, not only should we continue doing this business, you should think about getting this company on a publicly listed platform through an IPO. And that's where you not create wealth, but a generational wealth. And not maybe just for you, maybe for the investors you will who will invest in your IPO. I'm sure all of you must invest in the publicly listed stocks, and there are multiple stories. We cannot count those on hands, or numbers that people would have made 10x, 5x, 100x last 3 years has been very, very good for markets, and people have really made wealth. That is only and solely because those companies chose for this valuation magic. Okay, they created the market for their own shares, which allowed people to invest in their companies and help the valuation grow. At times, as promoters uh, themselves cannot believe what they can do with additional amount of capital and how the valuation magic can work. Only if you get listed, perform the way you have been performing. And it's not that to create this valuation magic you will have to do things very differently. You're running a business today, your idea must be wonderful. You believe in your IPO, you will need to just continue doing the same thing, maybe with probably a better vision to look at your own idea, and then go for listing to unlock this magic of valuation. We have seen again uh, uh, a lot of Indian conglomerates have been demerging their different companies and then coming up with an listing for those demerged companies to all of this is to unlock the magic of this valuation. Uh, Okay. The next point on and the last point on why you should, there are multiple other points, but just to summarize why you want to do IPO. One of the key words when we reach out to companies or we meet companies for an IPO is everybody is afraid from doing higher compliances. Our company will be under public scrutiny. Our company will be, my financials. Everybody will read my financial. They will ask me more questions. How would we do quarterly compliances for a main board IPO? How will we अभी तो हमको our balance sheet gets hardly prepared in September. We are on the deadline of that 30th September to prepare that balance sheet, and coincidentally it's 30th September today. A lot of you must be busy in that. How will we do that? Everybody is afraid. The promoters, the employees are afraid. It will make our life tougher. And that's why we tell companies, okay, you're only looking at the bad side of it. To just flip the coin, look at the good side of the compliance. As a promoter, if you are getting your balance sheet in your hand on 30th September, that too by scrapping, okay, it's not the good sign. So once you become listed company, you then don't have an option. अभी हमारे पास option है 30th September को balance sheet submit करने का. हमारी balance sheet 30th September को बनती है. You are a listed company, you will have to give your results within 60 days of your year end. You will have to do it. You don't have another choice. You will have penalties, and then you start achieving those timelines by default. So those compliances, rather than hampering your day-to-day work, it actually helps you do a better management of your own resources. You don't have to hire new people to have those own resources. A lot of companies, listed companies, if you see, for example, like Cyient or Infosys, they get their results out on 15th of April. I have seen companies getting their March results on first week of April. How do they do it? उनको भी तो compliance करने पड़ते हैं, but they do it through the power of better management. And that's why if you see the last point on the M&A type and compliance point, higher the compliances, higher the responsibility, and better the management. चाहे वो डर से हो, चाहे वो compliance penalty के डर से हो, या non-compliance के डर से हो, at least we are better managed. SME companies, small companies with a turnover of 25 crores, they are preparing their half-yearly balance sheet. The results has to go out before 14th of November. Just imagine a 50 crore turnover company preparing their getting their accounts limited reviewed half-yearly. The promoter or the management gets to look at those financials and decide better strategies for the next half year. Most of the unlisted companies would only make yearly plans, but then once they have results in their hand, they will be forced to think. They will have to think about half-yearly plans. And when it's a main board company, they will have to forcefully think about those quarterly results, because there is a pressure on again performing quarter to quarter, half year to half year, year to year. So those compliances, as I said, I only look at the good side of it. हम मजबूरी में करेंगे लेकिन compliances की वजह से अच्छा करेंगे. IPOs also opens up, as I said, it's probably a smaller point to your visibility and brand building, but it helps you on your M&A tie-ups. People will start looking at you. People will, if you're a unlisted company doing 100 crore turnover sitting in Jaipur, or any small town, it could be Guwahati, it could be any other small town, it could be Cochin, whatever it is. Okay, the investor would not know there is a bigger company sitting in Bombay or Ahmedabad. If you are thinking about an IPO, getting your brand more visibility, they can think, oh, this company can be good for our strategic tie-up. We can outsource this work. That portion opens up for you. All these strategic business associations, only if you have the visibility through IPO. It could be a main board IPO if you are eligible. It could be an SME IPO. SME IPO has been very helpful for those companies to come up the curve. And of course, it opens, the merger acquisition space for you. You can use your own shares for that, which, you cannot even think about being in unlisted shares. Even these shares can create as a collateral for your present banking facilities on the first point of finance that we spoke about. So overall, in nutshell, if I have to sum up on this why IPO point, I think the next slides are more regulatory or more process driven. And again, most of these points that we discussed are more qualitative, because on a quantitative side, we can only talk about finances. And we know, of course, IPO raising you money can help you on that quantitative side. But all of these qualitative benefits that you cannot, again, write down how much value it is getting for you, are very, very important. I'll tell you from my experience of being in the cap markets for last 10 years, IPO at times becomes a process which is very, very lengthy, at times demoralizing. But at the end of the day, last night, we were part of a deal which they filed the DRHP on for a main board IPO. We filed the offer document at 12 midnight, and the last 4 months of hard work from all those intermediaries. That could be 25 intermediaries, multiple law firms, multiple bankers, multiple CA firms on those IPO, and of course the company team, the investors. The relief that they get because once these filings are completed, it's a joy to watch. And this is just the first step of DRHP filing. The company will now go through the process of SEBI review. They will go to the investors to talk about valuations, etc. It's a tool that you can. I would only call it a tool because ultimately you will have to keep performing even after IPO to have the benefit of this tool. Okay, but it ultimately helps you in long run. So, and I'm a very, very fierce advocate for going for an IPO for the companies for all the reasons that I spoke about. So as I said, now we'll probably go more into who can do an IPO, how they should be doing an IPO, what is the process involved, key intermediates, etc., and then smaller few points. This is a very nutshell of which company can go for a main board IPO, and then we'll talk about the SME IPOs as well. There are, I don't know if you had any question sometime in your mind, how come a Paytm or a PharmEasy or any of these loss-making startups like Zomato, how they were able to go for an IPO? Because generally we associate the terms of eligibility criteria with profit making, etc. So SEBI, and I see a lot on social media, how come these companies are going for an IPO? What is SEBI doing about to stop these companies because they are not making enough money? There are enough provisions made by SEBI, and there are safeguards, of course, that they have done. So most of the, not most of the IPOs, all of those IPOs in India are regulated by a regulation called SEBI ICDR regulation, SEBI issue of capital and disclosure regulations. Considering that all of members who are listening are CA is here, we would have, all of you would have read this in allied laws chapters that while giving the exams. If you're not skipped that. So SEBI ICDR regulations is something which works, like a Bible or a Gita for companies to go for an IPO. It has Regulation 6, which drives the eligibility criteria for company. Regulation 6.1 and 6.2, there are two key regulations. Regulation 6.1 talks about the eligibility criteria. One of the criteria is net tangible assets of 3 crores in the preceding 3 full years, and not more than that. 50% of that should be in monetary asset. If the company is going for an offer for sale, they are not raising any money, then this not more than 50% of the money held in monetary asset criteria does not apply. The idea behind this is so I'll talk about the basic intention of SEBI to have these eligibility criterias also. Net tangible asset of 3 crores. The intention here is that at least the company's net worth is positive. And they don't want companies who have more than 50% of their net tangible assets sitting in monetary assets to go for an IPO, because or to raise fresh issue, because they think they already have enough money in their bank, so that they can utilize that money first and then they should come up for an IPO. I'll skip the second part of average restated consolidated profit. I'll come to the next part. Net worth of at least 1 crores. Again, there is not too much of difference between the tangible asset 3 crore and 1 crore. Most of the companies coming for main board will probably, if they have a positive net worth, they'll match it. The most important criteria which is under regulations is this average restated consolidated profit of 15 crores in last 3 years. The regulator wants to see the company they want the companies to show a track record of at least 3 years. The company should have made a operating profit, pre-tax operating profit of average of 15 crores, and all of the last 3 years should have some positive operating profit. How we calculate the operating profit in a normal parlance, and if you see a lot of offer document, you take your profit before tax, and then you add your finance cost, because that's not an operating cost as we would see, and then you reduce your operating income. In case of NBFC, we consider the finance cost also as part of our operating cost, so we don't deduct the finance cost when we are calculating the eligibility for NBFC. So, but talking about other companies, we take your profit before tax, we add back your finance cost which we had deducted while arriving the profit before tax, and then we of course deduct the other income which is not operating in nature, and that gives you that number. And that number for last 3 years, the average should be 15 crores, and every year should be positive. It cannot be a case that in FY23 you made a operating profit of 50 crores and you made a loss of 1 crore operating profit in each of the last 2 years, and then you are eligible because your net operating profit before tax is 47 crores. But you will have to have some positives in last 3 years as well. You cannot be just 1 year wonder and come up with a main board IPO. Of course, you should not have changed name in last 1 year. You would have changed your complete business. The regulator wants some sanity out there. They want whatever the name that you had, you earned most of your business from that name probably in last 1 year. And if you qualify all of these, okay, then you are a company who can go for an IPO under Regulation 6.1. If you don't comply with these criteria of track record, you will compulsorily have to go under an IPO, which is under Regulation 6.2. Now, this is where the difference between the loss-making companies and the profit-making companies comes in. If you would have noticed, all of these companies who are loss-making, something like Paytm, Zomato, as I spoke about, their issues were under Regulation 6.2 and not under 6.1. Again, the next question which will, of course, pop up, what is difference between then doing an IPO under 6.1 and 6.2 is the investor allocation. SEBI has seen that you have a profitability track record. It's saying you can do under IPO 6.1. They believe this company is more safe for a retail investor to invest in. And hence, if you see the investor bucket, okay, not more than 50% of QIBs, in case of 6.1 IPOs, I would call them profit-making companies and loss-making companies, just for our easier conversation. So in case of 6.1 profit-making companies, 50% of allocation goes to QIBs. QIBs is a term for qualified institutional buyers. It is defined under SEBI regulations. Most of those participants in the QIB would be your systematically important NBFCs with more than 500 crores under AUM or a net worth. Your mutual funds, your pension funds, investment funds, AIFs, all these institutional investors. It could be, LICs. All of your mutual funds comes into these categories. Your FPIs, NFIs, etc. Those falls into the QIB category defined by SEBI. The 50% allocation goes to them. At least 35% of these profit-making companies who are coming for an IPO has to go to retail investors, because again, SEBI is fine for a higher allocation to retail investors in these IPOs, since these companies are profit-making, and at least 15% of the allocation in IPOs should go to retail, non-institutional investors, which is in normal parlance you would call HNIs. If you see the comparison here for Regulation 6.2 IPOs, which is again Paytm, Zomato, SEBI wants only the QIBs or institutional investors, or we can call them well-informed investors, who will have better resources to judge a company. SEBI wants these companies to allocate at least 75% of the IPO size to QIBs, because they believe these IPOs could be more risky to retail investors, and hence the difference on allocation from 35%, at least 35%, to maximum of 10% goes to retail investors in case of these IPOs, if you notice here. And the HNIs remains 15%, but there is a difference there. There it was at least 15%, and here it is maximum 15%. And that's how these loss-making companies are allowed to do an IPO under 6.2. So these are, there are of course other, qualitative eligibility criteria, such as, the company should not be doing, the company or the director promoter should not be willful defaulter, etc., etc. I'm not going there. That's a laundry list there. But for you to understand the eligibility criteria and the difference between profit-making companies or loss-making companies doing IPO, that's what it shows. These are, again, as I said, main board IPO, SEBI approved. The document goes to SEBI for approval. This is eligibility criteria for SME IPOs. Again, approved by either BSE, NSE. SME companies has to choose one exchange to get listed. Every main board company in India would go for a listing on both BSE and NSE. They would, of course, main board companies will also have to apply for in principle approval from those companies. But in case of SME, the company has to choose one platform. It could be BSE SME or NSE Emerge. The SME platforms are named that way: BSE SME and NSE Emerge. The criteria are more or less very easy and very and the idea is to make it easier for SME companies to comply with eligibility criteria and eligible for the IPOs. Again, positive net worth, positive track record in last 2 years. That is also on EBITDA level. NSE is a bit tough, where they specify the eligibility criteria to be EBITDA on 2 years out of the last 3 years. They have also become stringent, probably last 1 year or so. Earlier it was just, if you had a positive year, the last financial year was positive and you were okay to go for an IPO. They've now made it 2 years out of 3 years. BSE SME is still that way. If you have had a positive year in the last positive year out of any of the 3 years, okay, and you are eligible to go for an IPO, your post-issue paid-up capital should be only 1 crore, which is again a very, very, very easy requirement. 1 crore of post-issue paid-up capital, and you are eligible to go for an IPO. Which is, if I have to compare for a main board IPO, which is 10 crores. So I probably I'll show some light on the 1 crore, 10 crore, and 25 crore. a SME company with post-issue paid-up capital of 1 crore, and we say paid-up capital, we don't talk about reserves and surplus, just the equity share capital. The paid-up value should be 1 crore, and you are okay with SME IPO. But a main board company can come up with an IPO only if their post-issue paid-up capital is 10 crore. And any company which has a paid-up capital of 25 crores and more will have to compulsorily come up for an IPO on the main board. So SME company till 1 to 25, they can do an SME IPO, but any company which is 25 or more, they will have to go on the main boards. So these are very easy eligibility criteria for IPOs that we have here. So we spoke about why should do an IPO, who can do an IPO. Now, probably next natural questions would be how to make an IPO successful. There are these couple of slides that we'll discuss on what it takes to do a successful IPO. The first point here is, of course, sizing consideration. You should, what is the size of IPO that you should be looking forward? What is the valuation that you're looking at? At times, it is imperative for the promoters, etc., to not, become too greedy to come up with an IPO. Everybody wants, of course, better valuations, but at times, if in the see, there is a minimum dilution criteria applies when you are doing an IPOs in India. Okay, the companies or the promoter of the company cannot hold more than 75% of the equity shares in a publicly listed company in India. There are a couple of exceptions there. If you are a very, very large company like LIC or a DMart, you can continue to hold 90%, but then within 3 years of listing, you will have to bring it down to 75%. But I'm not talking about those very, very large companies. In a majority of these companies, small companies coming with IPO will have to dilute at least 25% of their capital. Now, if you have to dilute 25% of your company, your sizing becomes important. You will of course look for better valuations, but वो ज्यादा valuations ही करने के चक्कर में अगर आपका issue महंगा हो गया, okay, then it's a problem, right? So sizing is one of the very key part when you are planning for an IPO, or I would say successful IPO. All of this hassle of doing an IPO, and we don't shy away from calling it a hassle for IPO. There are of course some negative cons of doing an IPO. The management, there is a distraction, the process is lengthy, regulatory challenges, etc. Okay, all of this results into good, but only if it's a successful IPO, and that's why your sizing becomes important. You will of course have to. I will move to the second point is investor marketing strategy. How are you going to market your investors? SME IPO, you don't have to look at the marketing strategy as much. There is a lot of there is a very less PR or a marketing involved in SME IPOs, considering the size is very small. The HNIs have become very active. But in case of a main board IPO, your investor marketing strategy is very important. There are PR firms available in India who do this for each IPO. There are two predominantly major players in India, Concept and Adfactors, who does most of the investor PR or roadshows in India for main board IPOs. So what kind of investors that you're targeting? Are you targeting the hedge funds? Are you targeting the long funds? Are you targeting the right mix of investors for your company? We evaluate what kind of investor that we are going. It becomes very important. So, for example, if I am marketing my IPO to a mutual fund whose focus is on, or a PE player who's, or a high-end investor who focuses on technology company. My company is a manufacturing company, and I'm pitching that idea or my IPO to the technology investor. It will not go well. So the marketing strategy to investors is very important. Again, the next 3 and 4 points are probably somewhere related to investor marketing. What kind of investors that you're targeting, right? Institutional, as I spoke about. You should know what does that investors like about, what is his investment thesis, and then only you should target that investors. Again, while institutional investors are important, equally important are your retail and HNI investors. Last 3 years has been a boon for HNIs and retail investors. They've probably they've made money, and they are driving a lot of IPO markets are crazy. You would see QIB subscription low, but the retail and HNIs are going gung ho. The HNIs and retail portion of IPOs are subscribed multiple times on day one, maybe in hours. Okay, and earlier it used to be the HNIs or uh, uh, retail investors used to follow only the QIBs. Now at times they just forget QIB. थर्ड डे पे आता था, उसके बाद में HNI और रिटेल का डिमांड भरता था IPO में. And last few hours were crazy. Once the QI bidding used to close at 1 p.m., you will see a lot of HNIs and retail coming. That happens still, but not like every IPO. At times, retail's subscription is filled in 1 hour or 2 hours of IPO opening. And of course, the last point on to make an IPO successful is the timing, of course. When you're choosing to, not just in terms of when you're launching the IPO, it could be seasonal. You cannot come up with an IPO in December end, like most of the investors are on holiday. The elections are near. Whenever you see, the key events like budget. So timing the IPO, how markets are doing, is very, very important to do an IPO. And to do a successful IPO to quote. Again, this slide is probably a more explanatory slide to the earlier slide. When I was talking about sizing your IPO, you will have to take key decisions. Are you only doing a primary fundraise, or you're doing some secondary issue? Secondary issue is the offer for sale. Primary issue is what we call it fresh issue. How much money are the company is going to need through IPO, and how you are going to utilize this money. Are you doing some capex out of it? Are you doing debt repayment? The object of the issue that we spoke in the very, very beginning of this session is important, because investors will look at what is something that you're going to do with money. Is the promoter doing offer for sale, taking the whole money of the IPO at home in his pocket, or he's just deploying the money in the company through a fresh issue? So the sizing and the construct of the IPO becomes very important. At times there is a negativity on offer for sale, and there are it's valid for reason. A promoter doing an OFS or a complete OFS is a negative to investors. So that's a very key point to consider. Leave something out for yeah. Of course, deciding primary issuance, secondary issuance, and then appetite for target investor base. What size of IPO? What is the valuation? We always encourage companies when they are doing an IPO is to leave something for the retail investors, because the last point here is healthy market performance, right? It's not that your company got listed in, this is what matter to you, right? You're in public listed market. You will create a benchmark after your IPO, okay? And then benchmark, this is where people will judge you from, right? So leaving something on the table for investors helps you creating that benchmark lower. And of course, if the benchmark is lower, you will always look good from there. So the float size and the value that you left on the table becomes important for your market after that. I'll probably be a bit quick now. This is a quick process overview of an IPO. This is a process overview for a SEBI approved main board IPO. The difference between a main board IPO or SME IPO is there is the approval for SEBI versus approval of stock exchanges. The regulatory process is a bit shortened in case of SME IPO, and necessarily so. Of course, you will involve a lot less marketing in case of SME IPO. So there are 4 key stages to an IPO. First stage is your preparatory stage, where you will appoint the intermediaries, all of the intermediaries. The first one and the most important being your merchant banker, somebody will call it investment banker, somebody will call it book running lead manager or a BRLM. So appoint your merchant banker, that's compulsory to do an IPO. And then of course you appoint the legal counsels, uh, uh, registrar, sponsor bank, independent chartered accountant, and a whole lot of intermediaries. Get them on the board, explain them what you're looking at for an IPO, ask them to start due diligence. It's a very lengthy process on due diligence. The regulatory requirements is as such in case of an IPO, and the disclosure requirement, by the way, in case of a main board IPO or an SME IPO are equal. There is no difference between how an offer document of a main board company should look or an SME company should look. So that's a very so process wise or due diligence wise, there is no difference between an SME IPO. It's just the regulatory approval which is different there. So do the diligence, prepare that offer document. If you see a common offer document of a company, it will involve lot. So and that's what I actually tell people to look at offer document of company before investing in IPO. May not be just for your for investment decision, but for your understanding of a company. If you look at offer document, the key construct there is the company's history, geography, future, where they were, how they started, what they want to do, how are they doing right now, where will they want to land up. Everything is involved. The litigation of the companies, the litigation of the promoters, directors, their history, their capability, their corporate governance, business risk factors, financials. Everything is involved in an offer document. An offer document is at times, people read a lot of books. Everybody says reading is a good habit. I would encourage people to maybe keep aside some fiction at times. We all are chartered accountants. Maybe keep the fiction that we read or the motivational books that we read. Maybe try picking up an offer document of a company just for your travel or something. You want to understand how DMart scaled up their business. Pick up their offer document and read. It takes a lot to prepare. To prepare a DRHP filing takes months for people and a lot of intermediaries to read those business part which is under this preparatory stage that we do for preparation of a DRHP. It's a good book to read, I would say. May not be again for your investment decisions. There are a lot of people guiding us on investments nowadays. So, but for your understanding as chartered accountant or a CFO of company or an auditor of company, it's a good to read book, I would say. And every company is different. That thought processes. Promoters are involved directly in preparation of the DRHP. They put their thoughts on the business section. This is how we did business. This is how we want to do our business. And the other next stage is, of course, DRHP filing and the regulatory approval stage. Of course, the document will go to SEBI stock exchange. They will ask questions. We will answer the questions, and there will be 2-3 rounds of observations from SEBI. And once every query of the regulator is satisfied, there will be an IPO approval. Some companies might take 4 months for approval. Some companies might take 2 months for approval, depending upon the complexity of or the questioning of the regulators. And I'll tell you, SEBI ask a lot of questions. Exchanges, they ask a lot of questions. At times, as an investor, we keep looking at companies. SEBI ne isko approval kaise de diya? There are thought processes. Of course, regulators they cannot stop companies from doing an IPO, right? And at times, the market price becomes a function of how market takes it. Regulators have done their diligence. They cannot stop companies because उनको लग रहा है कि नहीं valuation ज़्यादा है या ये valuation सही नहीं है. Ultimately, it is for the investors to take the call on valuation. But they still ask a lot of questions on the complexity of the business, the clarity on the offer document, and valuations nowadays. Again, next step, once the approval is there, you will talk about the marketing and pricing, how you should market and price the IPO to have the investors. And then, of course, once the issue closes, the process from issue closure to listing of the company, which is now T+3. RR Cable got listed in T+2 closer. I think the IPO closed on Thursday. They got listed on probably Monday, I think. So from T+12 days to T+6, now the issues are getting listed in T+3 days, helping investors their money more worth. When there are two back-to-back IPOs now, T+3, you can apply for another IPO if you don't get the allotment in IPOs. So this is a quick overview of a very lengthy process in 4 different stages. These are the key agencies involved in an IPO. Of course, your BRLMs, domestic legal counsels, counsel, international legal counsels, auditor, registrar, PR agencies, printer, industry consultants, bankers to issue, monitoring agency. Monitoring agency, by the way, is something, any IPO of more than 100 crore rupees, the company has to appoint a monitoring agency. And in India, credit rating agencies are agencies who can work, who only can work as a monitoring agency. Now, it used to be earlier, even the scheduled banks were eligible to monitor an IPO proceeds, but now SEBI has made it mandatory for only credit rating agencies to be appointed as monitoring agencies. They will monitor the whole money utilization. They will give their monitoring report. Their monitoring report then will be uploaded on the website of the stock exchange by the listed company. But that is only for a IPO which is more than 100 crore now. Otherwise, for more than 100 crore, they will monitor the whole money. For less than 100 crore, the audit committee of the client, the company, and the statutory auditor have to give the certificate on utilization of money. See, for SEBI, it is very important that how companies have utilized their the money or the objects money that they raise the money for. So yeah, I'm not going in very detail what a particular agency will do. It's probably self-explanatory from the names. Role of CF and I thought, we'll just touch upon quickly on how important it has become for the role of the CFO and CS in case of companies. When we reach out to a lot of companies and we work a lot on IPOs as part of our routine practice, CFO and CS, these two are very, very key role when we do an IPO. The whole IPO process revolves around them. Of course, there is a promoter sitting on the top, but to feed the promoters to deal with all of these intermediaries, like these are just 10 major intermediaries I have named here. Other than that, there are a lot of other people, independent chartered accountant, chartered engineer का certificate चाहिए because manufacturing capacity और utilization के बारे में दिखाना. There are बहुत सारी चीजें हैं. IPR consultant चाहिए because ये बताना है कि कंपनी के पास कितने ट्रेडमार्क हैं, कितने ट्रेडमार्क अप्लाई किए हैं, etc. etc. लिटिगेशन के लिए एडवोकेट से डील करना है. All of this is done by CFOs and CS in tandem together. Very, very important role. Very, very and it's an opportunity once in a time. If you are a chartered accountant who is a finance controller, or in finance team, you are your spouse is a company secretary, whoever, it's a opportunity of a once in a lifetime. If your company is doing an IPO, you should get involved in the IPO process as much. It does not only teaches you about the IPO process, but the pressure which comes through this process can change you as a person or as a professional. We have seen a lot of these individuals come up the curve. Their lives have changed because they once got involved in IPO process, which could be 4 months, 5 months, but those were crazy nights. There will be multiple night outs, etc. But the learning curve, what you might not have learned in last 5 years out of your professional lives in terms of pressure, you might learn in 5 months. At times, the CFO's role becomes more important because they have to, more than the company secretary, they have to not only deal with these intermediaries, they will have to talk to investors, they will have to go on road shows. Your public speaking, your understanding of financials of your own company, how you need to present it to investors, and then reporting it to the promoter. At times, the CS reports to CFO. So for the CFO to even look at the work of CS, CFO is probably the most important person in an IPO process. Other than promoters, promoters will drive business and decision making, but CFOs is something who will be in the bridge in between and help you. And when there is no CFO, if you are a practicing chartered accountant listening to this, if the CFO of the company is not as dynamic, you can take up that role as a practicing chartered accountant. The company better than anything as an auditor of that company. You can play that role of the CFO and help the company be a bridge between these intermediaries and the company in between. That's a whole IPO management practice that we run, where we become the bridge between companies and intermediaries. Yeah, very quickly on these. This is the last slide. Some key discussions, might come to your mind when you hear some discussions on IPO. Allotment process. मुझे allotment क्यों नहीं लगता है? It's a very automized process of allotment. The most probably reason for you not getting the allotment in an IPO is your luck, or a fraud, which is very, very difficult to do. It's a lottery based process, automized process. There is no way you would not get allotment if you were to get allotment and if your luck had permitted. So again, 99.9%, if you didn't get the allotment, it was your luck more than anything. The applications are set in some way, then reverse the order, then it will be drawn groups of those application number wise. There's no name or a pen involvement when we are doing the allotment process with the stock exchanges. Then lotteries will be drawn. If you are lucky to get that lottery with your qualifying number, you will get the allotment. Lot size in SMEs, SME IPOs, the minimum lot size when IPO comes is at least rupees 1 lakhs, and depending upon the issue price, it could go anywhere between 1 lakh to 1,15,000. In case of main board IPOs, of course, the minimum application size is 10 to 15,000. In case of an SME, market maker is a compulsory. You have to appoint a compulsory market maker there, which is again mandated by SEBI. The intention is to create more liquidity in the market. Lock-in requirement, of course, a very key point here. If you have invested in an unlisted IPO space, your share, all shares other than ESOP shares goes into lock-in for at least 6 months in case of main board IPO, and for at least 1 year in case of an SME IPO. So if you are holding unlisted shares of a company, please be aware, if the IPO is happening from the date of allotment and IPO, your shares, pre-IPO shares, will go under lock-in. Even if you bought those ESOP shares from an employee and you bought it as a without employee, then your shares will go under lock-in. It's not that because you bought those ESOP shares, it will not go under lock-in. Only ESOP shares, if held by employee, will not be under lock-in. Promoters shares are of course locked in for at least 1 year. 20% of these shares are at least locked in for 1 year. So that's a key point. You should as an investor, you should track. There is a lock-in for anchor investors, 30 days and 90 days. That you should track, because then the selling comes in market once the lock-in periods are over. So you should track that lock-in. Insider trading, of course, you should not, if you're a company going over an IPO, should be aware what you're talking to public about your IPO or your company. It should not be different from what you spoke in offer document. Minimum dilution, I spoke in between. Minimum 25% dilution is something which is required for an IPO. Yeah, I think I'm open for questions now. I hope I tried to summarize again. We can speak for probably more 2 more hours on IPOs and other nitty-gritties. But happy to answer if you had any more questions which I didn't cover in my presentation.
Sir, we have some questions. SME
Sure.
IPOs are not suitable to retail investors. Will you agree?
I would I would disagree with respect. Okay, if you are an investors, whether it's a SME company or whether it's a main board company, if you are making your investment decision, a well-informed investment decision, it is suitable. See, ultimately, you are investing in an IPO to make your money on your investments, right? You have to look at the nitty-gritties. I would not generalize that SME IPOs are not good for retail investors. If there's a term called multi-bagger, right? So if you want to look at multi-baggers, an Infosys would not be a multi-bagger from here than a company which is growing. So let's not generalize this. Probably evaluate better or look in more depth for those SME companies, and hence the reason SEBI has kept the lot size to at least minimum 1 lakh rupees there. It's for that reason, because SEBI wants you to make your decision well informed. You're not putting 10,000 rupees there, you're putting 1 lakh rupees. So let's not generalize, I would say. You may disagree, but I respectfully disagree that it's not suitable for retail investors.
Okay, sir. Sir, next question is, some IPOs are highly priced. Is there any regulations to protect retail investors?
Again, I think I spoke about this. SEBI have started asking companies on valuations, and if you see, there was an amendment in November 22, 21st November 2022. SEBI has mandated now. If you look at, there is a section called basis for offer price section, where now companies will have to start comparing their valuation matrices, how they arrived at their valuation, and how they stand against the peers of the company. So they are now comparing the key performance indicators of those particular companies who are coming for their IPO with their peers. SEBI cannot regulate ultimately the decision of an investors. Again, if you see, आज के market में भी if somebody sells, somebody buys. So somebody who is selling in even in a listed company, आज मैं अगर Infosys 1500 रुपए पे बेच रहा हूँ, तो मुझे लगता है कि वो मेरे लिए महंगा है, बट अगर कोई 1500 रुपए में खरीद रहा है, तो उसको आज भी वो सस्ता लग रहा है. Right? So regulators ultimately cannot go, decide what is cheap, what is not cheap. They try to pressure companies or mandate the requirement or disclosure, but the ultimate investment call is with the investor.
Sir, which companies are good for energy sector?
Sorry, I don't track any investor, energy sector, and I cannot comment on any particular company here. Sorry about that.
Okay, sir, no issue. Sir, I think all queries have been resolved. Can we move forward for next?
Sure, please. Thank you so much, and a pleasure having you all.
Thank you so much, sir. So now I welcome our next speaker, C. Giriraj Bank. Sir is qualified in 2001 and having 22 years of experience. He has also Secretary of Vasai branch of WIRC of ICAI in 2022 and also worked with Valuation Committee of WIRC of ICAI. Sir is also worked as advisory in equity and financial instrument, fundraising, GST, income tax, and many more. Sir, I request you to please share your thoughts on equity analysis. Please, sir.
Thank you, Abhilasha. Thank you, Abhilasha, and committee members to invite me here. I'm glad to share my thoughts, whatever limited thoughts we have and experience we have gathered during our working. I'm sharing my PPT.
Yes, sir.
Yeah.
Sir, visible.
It's visible now?
Yes, sir.
Okay, fine, great. So, a topic given to me is equity analysis. So today we'll just understand how we should look the equity market as a whole, how we can make money through the equity market, investing in equity market. So basically, whenever any investor or any trader comes, what's there in their mind? So our major objective is to invest in equity market is locating investment opportunity in the market to improve the returns and protect the capital. So our major objective should be first protect the capital, then we should try to improve our returns. How we can do this? This we can do through a stock selection process and understanding of valuation. These we will take up later, and this we need to understand. And our whole presentation is go through the opportunity in the equity market. So what kind of return we should expect in the equity market? So whenever we are going for the investment, like what options we have other than equity market? Like we have FDR, there are various debt products. One is FDR, then bonds, then PPF, and something like that. And our efforts should be at least earn better return than these financial instruments. Now, when we choose equity market over these financial instruments, then next step is we should look for better returns than the market returns. Now, whatever gives us the return, we should have a knowledge, understanding, and we should put all the effort that we get better return than the market returns. And third is we should expect a reasonable return. Whenever we ask any investors who is investing in the equity market or who wish to come to the market, they want to double their money in 1 year or 2 years, and this is something not expected, and that this is something not possible and not expected. And even if they get return, for example, they get return say 40% in a year, 100% next year there will be either time correction or price correction. So eventually their return will fall to reasonable one, which is equivalent to the corporate return which the market gives, which the company gives. Now, what are the definition of reasonable returns? Now, we need to understand the returns, how the company gives the returns. Our returns, which the equity market gives, is completely depends on the corporate earning. In the short run, stock prices can go ahead of fundamentals, can be behind of fundamentals, but in the long run, stock prices has to fall with the corporate returns. So as I said earlier, even if you get, say for example, corporate return, if you invest in any company and that company grows by 15%, there is possibility that you get 40% in the first year if you invest in that company. There is highly possibility that in the next year there may not be any return. So on an average, your return would be around 20%, 15 to 20% only, which is equivalent to their corporate earning. One thing we need to bear in mind that corporate earning, that is corporate cycle and stock market cycle could be different for any particular company. Like any company may be doing well in the corporate earning, but which may not be reflecting in the corporate in the stock return. But sooner or later, all those earnings going to be reflected in their corporate in their stock return. So that gives an opportunity if company is doing well, giving decent return, but still this is not reflected in the stock prices. Stock prices, that means stock prices are low. And this gives us the opportunity to invest in those companies. And in their situation, there is high possibility that we will get returns which is above corporate earning or better than the market return. This is what we should look into this. Here we have tried to try to explain that whatever business we are doing, like you all must be either doing business or maybe doing auditing some of the businesses of your clients. Let us understand whatever businesses you are auditing, or even if you are doing, what kind of return those businesses are giving. There is lot of effort goes in the whole year, like looking for the clientele, looking for the funds, selling the product, manufacturing. Then at the year end, we get to understand that company gave us return on equity, say 15%, 20%. So in that scenario, we need to understand that the people who comes with the market with the expectation that they should double the money in 1 year, 2 year, how it is possible? Company itself is earning returns of say 20%. Stock market cannot give returns more than 20%. Even if give returns more than 20%, next year there will be price correction or time corrections anywhere. And there is one myth in the stock market. The stock market is a gambling, it's a setup. Then we need to understand that, we need to explain that it is not a, this depends on the behavior of the investor or trader. Whether they want to speculate, it is set up for him, and if they want to play as a investment or play as a business, it is an investment. It is not a setup, it is a business for them. And if you are doing your own business, you are putting all the efforts, there is risk in the business, and it is a self-management. So we don't call the business which is run by us as a sector or gambling. This we call it a business. And now when we invest in the businesses through stock exchange, okay, so what different we are doing? We are putting this is also the business managed by somebody else's. Only thing is management is different. Business is doing by somebody else, and your investment in those business will increase as per the corporate return that business gives us. So we should look uh, at the stock market as the opportunity to pick the good businesses that runs well, that create the wealth. Here we should look into this information. We should build up the habit of reading. Like all those informations nowadays are available easily on the internet, on the website. Like annual report, this is something very basic. Company's website, we can look many details in the company's website. Then every quarterly, SEBI mandated results of listed space every quarterly. We can look or go through the quarterly results. Then management gives commentary consistently, especially after quarterly result. We should listen to the management commentary that gives us the idea of business outlook of that company. Then there are various brokers reports are available in the market. Brokers report gives us the in-depth analysis of the result, and that gives us their viewpoint about the company. So if we read these 5 details, it gives us a much insight in about the business, about the company, about the management. That will definitely help us in deciding on our investment strategy. Here there are some assumptions. This is fundamental assumptions based on our readings. Say for example, there are 3 scenario we have created here, and the street always assume scenario number 1, and we understand street is most of the time street is right. So whatever stock price reflected in the stock exchanges, if they are equal to fundamentals, we are understanding whatever corporate earning the company is making, whatever future outlook the company have, everything is reflected in the stock market. If this is the scenario, then stock price is correctly reflecting the fundamentals. In that situation, if we invest in that situation, then we are investing at the fair value, assuming that situation is correct, and our return will be equivalent to the corporate earning. So if the corporate earning goes by 15%, our return will also go by 15%, because here assumption is that particular script is fairly priced. And this is the street assumptions, and this is we understand this is most of the time this is correct. Next scenario is stock price are way ahead of fundamentals. So here we understand as per fundamentals, say prices should be 100 rupees, but stock prices reflected in the stock exchange is say 120. So if we under that situation, if we go to invest at 120, there are high chances that our probabilities of returns would come down, and we definitely try to avoid to be caught in that situation. Now, third situation is the best situation for us. We say stock price is undervalued as compared to their fundamental, and this gives us the margin of safety. Say the reverse situation where as per fundamental price should be 120, but stock price in the market is 100. So here is a gap of 20 rupees, which is the margin of safety for us, even if we go wrong in the fundamental. Because when we do the fundamental analysis or many analysis before the investment, there can be it's not an exact number, it's the range. So if there is a gap of say 20-25%, then we are safe. Even if we go wrong in the fundamental, at least we will not fall below the stock prices, which is 20, which is 100. So this gives us a margin of safety and safety of capital. And here, this is the situation, this is the best situation where we should invest in the money, in the capital market. So how to assess the fundamental, whether the price value as a fundamental, what should be the value exactly, how correct this is. For this, we will take up later in the stock selection process. We will explain in details later on. So here is the opportunity, and in the first scenario, we will have a reasonable return as per the corporate earning. In the second scenario, we may get a lower return than the reasonable return, or we may end up even making losses. In the third scenario, which is the best scenario for the investors, here we understand earning will be better than corporate earning. As we see how we can get better earning than the market earning, if we invest in the third scenario, we will always have a better earning than the market earning. If market gives 15% earning, we will have a 20%, because we are valuing, or concept is we are buying at a value which is much below the fundamental value. Here we are trying to look at the opportunities. What are the opportunities available in the market? We should always keep on looking for the opportunities in the market. Please bear in mind, in the market, always bull run is going on. Bull run can be either in a particular script or in a particular sector. So we should always keep, for example, in a few days back, like government sector, PSU banks was running well. So though the market is on the high, still PSU sector, especially public sector banks, have doubled their returns in 1 year. So somebody have looked or assessed the opportunity in that particular sector, and whoever invested, they have doubled their money. Then in the Corona time, though the market was falling, but the chemical sector and the pharma sector was going very high. So though the market was falling, but some sector was running well. So at every point of time, even if the market is on the top, we should look for the opportunity either in the stock or in the sector. Somewhere you will get a better opportunity to invest. Now, whenever there is corrections can be of two types, time and price. Whenever there is a correction or crash, we should look for the opportunity to invest in the market. So whoever invested like during the major crash, we will see it later. They have earned the decent amount of money, or say 30 to 40% returns in the next 6 months. And next, very important that we should bear in mind is we should pick the leader or stock which is capable of becoming leader in the sector. So whenever we are picking a sector, we should pick either the leader top one or second, third, or any other stock which has the capability of becoming the leader. As we said, we need to protect our capital also. So to protect the capital and improve the returns, which is our major objective, we should have these things in mind while investing. Then many people say, and it's very easy to enter the stock market. What's most difficult is the exit. Nobody knows when should we exit the stock market or any particular script. So here we have mentioned 5 scenarios where we should think of exiting the market or exiting the particular script. One thing is downtrend in CAGR in revenue and profitability. So our major or component in or factor in decision making is revenue and profitability. If revenue and profitability is going up year on year and for a longer duration, say for longer duration 10 20 years, and if it is going by year on year 20%, we should keep on we should invest and stay invested. When we understand there is not much growth is available, for example, in the bigger companies, we will understand the growth is say 5% or 7% or maximum 10%. So if we understand the company is not going to grow as these companies were growing earlier, or growth is going to slow down in that particular company, we can think of exiting that particular script. Then second option is if we have a better opportunity in the market. For example, if we understand a particular script where we have invested or we are already invested, say is we expect a 20% return, and if there is another script in the script in the market or opportunity in the market that may give 25% return, we can think of exiting the our existing investment and switching to the other investment which may give better returns. Third situation, when we think prices is too high and way ahead of fundamental, that means it is overvalued and maybe next year there may not be price up, or there may be reasonable price may go up, or there may be time correction that stock prices may stay as it is. So in that situation also we can think of exiting. Third is to lower the weightage in the portfolio. We make the portfolio to allocate the fund, to manage the risk, and to manage. And in any particular script, we have a weightage. Say we can have, if there is 10 script in the particular portfolio, on an average we keep an weightage of 10%. And if we think then in a particular script weightage has gone up, say 12% or 13% for any reason, either prices have gone up for that particular script, or we may have invested more in the when the prices were down, then we can think of exiting this script and lowering our weightage in the portfolio. There are various news like Corona or World War, or there may be various news, or there may be news specific to the company. And if we understand news is negative and damage is permanent, not reversible, we should exit that particular script immediately. And all these things we will learn by reading consistently, as discussed or spoken earlier, and following the concept of stock picking process. Then here, just understand how we can better up our return. In 2000, company like market, this is Nifty return, and it is in 2000 Nifty gave 44% return. As I told you earlier, in the next year 2001, either there would be price correction or there would be time corrections. Like in 2001, company gave us price correction and there was negative return of 26%. On an average, you will understand returns of 2000 and 2001 all put together, returns would be around 14%. In 2008, return was 30%, 35% minus. And then in 2009, there was an opportunity as there was a sharp corrections or crash in the market, and whoever invested in that particular situation, panic situations, market gave them better return in the next year, which is 73%. Similar situation was there in 2020. You will see there was a fall of 26%, and the next year there is return of 71%. So here we can get the opportunity, we can think the opportunity whenever there is fall in business, fall in stock prices, we should invest. Whenever there is stock prices very high, like in 2020, in 2000, we should exit partially, and light up in our investments. So this is one more opportunity. We should look into the market, and this will better your return. Then we should look for the corporate events. Like if there is any change in management, we should have all these eyes and ears open for understanding, knowing impact of all these actions. Like if there is any change in investment, key management, like in ICICI, after we can all see after exiting of Chanda Kochar, what happened, new management came and how they turned around the bank. fund infusion by the promoters, that gives us the confidence in the investors that company is sound. If the company is looking for the expansion, we can think of investment in the company. If company is adding any new product, any segment, that means definitely we should understand the fundamental impact of that. And if it is going to positive, we should add up our investment. Then there is a bonus paid dividend. We should bear all these in mind. Then lastly, quarterly result. We should diligently analyze the quarterly result. Then brokers analyze report, etc. Then next product is the picking up wrong stock. This is the major mistakes we can make in the market, is picking wrong stock. This we can avoid how? By following the stock selection process, we can curtail this risk. And still, if we caught up in picking up the wrong stock, we should learn our mistakes early and exit that. Then next thing that we should bear in mind is risk in the market is linked with the duration as well. In the short run, risk is more. In the long run, there is no risk. And this risk also we can mitigate by following the valuation process that we will learn later. Pick stock with margin of safety, high margin of safety, that we understand the third situation. Whatever undervalued stock, we should go for that. That will give us the different, that will protect the capital and give us the probability of returns would be much better. Then this last line, stock cycle and corporate earning cycle may be different. As I said, company may do well, but stock prices may not do well as per the company, or company may not do well, but stock price still doing better in the market. So as per that, we can take the decisions accordingly. Then this is returns in trading. So there are two kinds of outside. One is trading, one is investing. And anybody is trading, what kind of return they should expect? Here concept is like profit of one person is loss of another person. So whenever we are trading, if I sell, whatever profit I am making, I am assuming that somebody else would be making losses. In the investment, that is not the case. If two people are invested in the company, company is doing well, prices would go up and both the persons would earn the fantastic return. But this is not the case in the case of trading. In the case of trading, if one person lose, another person earn. If we put return of both the participant, the person who sell and the person who purchase, you will understand the corporate earning that company gives will be equal to their market returns. In the trading, returns are unreasonable. It can be high, it can be low. We can't expect much better. It's very difficult to earn for retail. See, earning in trading is very much difficult as retail participants are competing with the big player. As I said in the first point, in the trading, profit of one person is a loss of another person. Okay, so when we are trading retail, as a retail trader, if I sell, somebody else is buying, or somebody else sells, retail investor is buying. If we are competing with the big player like mutual fund, HNI, DII, we need to understand that we cannot compete with them. They are doing heavily trading. They have a lot of expertise, and because of that, retail people in trading make losses. So suggest to avoid this trading in the stock market. Then returns in the investing. Here, as I said, profit of one person is not the loss of another person. Both person make the similar returns. In investing, investor views wealth creation through power of compounding of returns in the long run. Like in the first year, they will earn say 20%, second year they may earn 10%, third year they may earn 15%. On an average, in the long run, wealth creation happens, and this power of compounding is the seventh wonder or eighth wonder of the world. So in the investment, wealth can be created to stay invested in the long run and through power of compounding. Without power of compounding, it's very much difficult to create any wealth. And the probability of earning is high as long as business is doing good. As long as business is doing good, we should stay invested. Probability of returns would be better. And this is the Nifty 50 returns. Like even if we avoid everything, if we invest in the Nifty 50, like these are the 50 companies, average return the market gave in the last 20 years is 12%. So here we need to understand, if we are choosing to invest in the debt, which gives us 6%, 7% return, that is also not tax efficient. Without thinking or without having much moderation, without need to study much detail, can we invest in the Nifty 50? That gave us the return of 12% in the last 20 years. So in last 20 years, there was a compounding by 12% year on year. And you can imagine the wealth Nifty has created. So we can, if we are not comfortable in a particular stock, we can have or we can consider the investment in Nifty 50 or in mutual funds or something, block of investments basically. This diversify our investment and reduce our risk. And this is the risk management. This also we should, while investing, we should have these things in mind. That while investing, we should have a large company, large cap companies, mid cap companies, small cap as well. Possibility of downfall in the large cap is very less, and it will go up faster. Whenever market improves, it will go up faster. Possibility of downfall in the mid cap and small cap is much high, but the expectation of returns is also high. But once it falls, it's very much difficult to come to the earlier level. So we should build up the portfolio of large, mid, and small cap, like flexi cap kind of, and we should have large cap company in our portfolio as well. And if we get the undervaluation, if we get the large cap companies which is fairly undervalued, we should go for it. And one more thing, if I am expecting from large cap companies 15% return and from mid cap or small cap 15% return, we should choose the large cap companies, not the small cap or mid cap. This is to protect our capital and improve our returns. Then risk management. Portfolio allocation of fund and making portfolio is the one of the way to better our return in the market. I think we can keep 15 to 20 companies of portfolio. We can manage these companies better. We can do in-depth analysis, and over the whole year, we can keep all the tab on all the corporate actions about the company. We can tab on all the corporate news or macro news about which may affect these companies. If we have more companies, say 30, 40 companies in the portfolio, then it would be very much difficult to keep the control, keep the details, and keep the tab. And this will be risky and not advisable. And concentration companies, say 5 companies, if we are investing, is too risky. We should not go for it. So moderately, we should have a portfolio of 15 to 20 companies there. And in these companies, I think in the market, there are over 6,000, 7,000 companies listed. And to make the wealth, we need only 10, 20 companies. We don't require more than that. And if we are able to fetch these companies properly and stay invested, nothing like it. This is the best way to control our risk, and let us understand who are the market participants. SEBI is the regulator that we know. Then Stock Exchange, Bombay Stock Exchange, and NSE. These are the exchanges where we trade. 2 primary stock exchange. Third one is stockbroker, through whom we put our all the transactions. Then lastly, you and me, investors and traders. And this is a category of investors. These are two kind of investors. One is like you and me, retail. Generally, we have retail people have very limited knowledge, experience. कोई advisory services नहीं है. Money power is also very less, and they are part timer. They are either doing some or other businesses or doing job. With all these limitations, if they compete with the another kind of trader, we who are FII, DII, HNI, I think they possess great knowledge, money power, advisors. Do we think that we can in the trading retail versus FII we can beat them? It's very difficult, and that is the reason we lose. Retail traders basically lose the money. So for retail people, best way to make money is the invest. No problem. Trading is very difficult. Earning money against these big giants is very difficult. Then there are traders. Next two kind of people: traders and investors. Traders generally buy and sell in the same session, very short duration, and they look for the gain of 2 to 5%. And if you have to understand, if you are trader, then you bear in mind that you are trader and you follow all the process, rules, regulations of trading. I'm not saying trading is bad, but we should follow all the rules and regulations of the trading and follow the process. Your objective, trader's objective is only to earn 2% to 5% in the short run, and they should go for mandatory stop loss. And obviously, process is mandatory, which is technical analysis they should learn. As against trader, there are another kind of participants, the investors. For them, fundamental analysis is a must. So they should go for the stock selection process, fundamental analysis. Stop loss का जरूरत नहीं है. And pick the good companies and stay invested. They will make money definitely. Relative risk as compared to trader and investor, trader is having high risk. Investors carry very low risk. And these are the few things that we need to remember. We know the price, need to identify the value. So we should know the prices are there in the market and what are the values. And value can be, we can understand, we can have an understanding while going through some stock selection process or understanding some fundamentals, understanding the businesses. And most important, we should not lose the capital. If you lose the capital, you are out of the market. And if you want to make money, you have to be in the market. Follow the disciplines. There may not be much intelligence required. According to me, there should be it's a much of game of discipline and patience. More the disciplines we have, more the patience we have, we are more the better opportunity that we will be the winner in the market. Then we should always invest in the stock where we have a margin of safety, like undervalued stock, as I said earlier. Then this is in-depth analysis of companies. We should have corporate. Everything goes around the corporate earning. If company is not earning well, irrespective of the market going up, your stock price will not go up. So we should first criteria is we should invest in the company who is earning corporate, who is earning well, who can continue to earn for the longer period. That company should be able to give the growth, like CAGR growth, year on year. The company should give us the growth in the earnings. Then this is the behavior of the investors, normal behavior. Like most of the people investing on calls, on tips. We should avoid that. We should be very clear whether we are investors or traders. Accordingly, we should decide companies. If we are trader, we should either gain 2 or 5% or lose 2 or 5%, then exit. We cannot be trader in the profit or investors in the losses. Like people sell script at a profit of 5% and become the long-term investor in the loss, and they stay invested even till wealth erode, say 50 to 70%. We should not do that. Timing the market, we should not time the market. Nobody has been able to time the market. Now, result is if we try to time the market, result is we either tend to buy either high or sell low. Rather than what we should do, we should be a consistent investor. In every fall, we should invest. Assuming company is good, we have pick up the company based on proper analysis, proper reading. Then next behavior is all the people prefer the small value stock or penny stock. सबको वोडाफोन में इन्वेस्ट करना है, एमआरएफ में इन्वेस्ट नहीं करना है. MRF gives the safety, Vodafone gives may erode your capital. So we should look into this. And this is introspection we should do, how whether we are trader investor, how we are, whether we are selecting, following any stock selection process, or we have made any stock selection process for ourselves. Stock selection process can be different for different people. Everybody can design, customize for their own. These are the myth about the market that it's too risky. I think market is maybe risky for the trader, and it gives us, for me, it gives us the opportunity to invest in the better business. Speculation for trader, yes. Speculation for investors, it's a business. There is no difference if I do business myself or I invest in the same business listed in the stock exchanges. I think in both the situations, things is business. There is not much difference. And for trader, yeah, it's a speculation. For investors, it's a business. Retail investor always burn their money in the market. Who retail trader have burned the money in the market, not investors. Investors have always made their money. You can ask the investors, retail investors, or retail traders how they perform in their life. Stock market is not for retail investors. Yes, stock market is for retail investors, not for retail traders. इन्वेस्टर्स के लिए है, ट्रेडर के लिए, रिटेल ट्रेडर के लिए नहीं. Now we are going for the stock selection process for the investors. Here we are quickly run through the basic things that we need to look before we choose any particular script. So here I divide in two categories. One is business. Second is management, and third is valuation. If business is good, management is good, valuations may be high or low. There may not be much difference. Or if quality of business or management is bad, then there is no future of that business, and we should perfectly avoid that. So primary importance is quality of business and management, and last, though important but may not carry that importance as the quality of business and management, which is valuation. In the valuations, if the quality of business is good, management is good, then what can be where we can go wrong? In terms of valuation, we can tend to buy a little bit expensive. To that extent, we can go wrong, and to that extent, our return would be lower. That's the only risk we carry. But if quality of business is good, management is good, and valuation is also good or undervalued, then that situation is the 24 karat gold. We should grab that opportunity. Quality of business good, management is good, and valuation is fair. And if we go for investing in that kind of scenario, we will have a reasonable return. We cannot have a superb return. So we are analyzing this quality. What is quality of business? In quality, what we see, like what is business model, whether they are manufacturer, importer, exporter, service provider. Accordingly, we can understand the businesses. We can visualize their financials according to this model. Then then we should do product demand, product supply analysis, whether there is high demand, high supply, or scarcity of demand, high demand, something like that. Then third is whether it's B2B business or B2C business, like business to business or business to customer. Next is whether that business is sale in cash or advance or credit. if that business is able to sell in cash or take the advances, that means that business carries much value in the market, and that product is in demand. We should prefer the businesses which sell in cash or take advances. Here you can say Asian Paints, they sell in advance, cash and carry business. You can take another business, DMart, cash and carry business. These businesses carry high value. Then business should be scalable. Like business should know, it should scalable means it should business should have a capability that it can go high year on year. And third is next is competitions. We should look for the competitions while investing in a particular business. For example, so see for the situation when DMart, there was a DMart script listed in the market. Then there was a news that there is one more competitor is coming in the market. This is Jio. So the moment that news flash on the TV, there was a correction in the DMart shares. See the Asian Paints. Asian Paints is in the paints business. The one big player is coming in the paint business. Now, due to that, Asian Paints is not doing well as that was doing earlier because of the competition. So we should look very closely who are the competitors in the business. Then we should invest in the market leaders, capability, or the companies which can become the market leader. Then we should look into government regulations, like in the power sector. There is much intervention of the government. In the infrastructure, there is much intervention of the government. Whether that business has the pricing power. If the business has the pricing power, we should go for it. If there is no pricing power, then that means the business is not a monopoly kind of business. There, if competition is very high, then obviously pricing power will come down. So competition and pricing power go hand in hand. Then what are the major costs? We should look for the major cost. Then we should look for the open our eyes for the news that comes and that impact the company's major cost. Then availability of raw material, labor, then availability of power and fuel. These are basic necessities, whether they are available enough. Then next we should look for revenue and profitability. Like revenue, when we see revenue, like for example, if we see the revenue in the balance sheet 1,000 crores, we can see the corresponding collection also whether the company has collected those 1,000 crores or not. It should not be the case that the revenue is only in the books. There is no collection. So profitability से better picture cash flow देता है, and I think we should look for profitability and cash flow hand in hand. Cash flow from operation gives you much better picture. Then margins, profit before tax, profit after tax, we should look into it. And next important is segment report. Segment result, we can see how the company is earning, which segment is doing better, which segment is not. And then segment investment, in which segment fund of the company is invested. We can look through the segment report, which is mandatory as per the guidelines. Then funding, what are the promoters funding? More the promoters funding gives the confidence, better confidence. Debt borrowing, usually market don't like the debt, high debt. They prefer the low debt, and we should see debt equity ratio is very much in control. Then what about the expansion? If company go for expansion, then whether they need to raise the capital or they can use the internal accruals. It's always better if they can fund their expansion through internal approval. So we should look into the balance sheet, like cash balances. What are the cash balances available for the expansions? Then how the working capital the company manage, like debtors credit period. As I told you earlier, like revenue should be correlated with the collections. If say debtors credit period is say 90 days, uh, in the last year, this year it is 70 days, then we can say yes, company is improving, demand is improving, or company is in the power to reduce their credit period. Then there is inventory days, how much inventories we are keeping. If we are multiplying the inventories fast, we need a lower capital to run the business, and accordingly higher return on capital. Current asset ratio same, it gives us the sense of solvency, that we are in better position to meet our all short-term liabilities. Then we should look for, in the balance sheet, there are we can look for installed capacity and utilization, that whatever company has installed their capacity. For example, if 1 lakh metric ton capacity company have, and company has utilized 1 lakh capacity, then we should bear in mind then how the company will grow in future, because every company has a capacity, and beyond that capacity, if they have to grow, they have to increase the capacity, and increasing capacity means they have to go for the expansion. Then expansion means they have to go for the funding. Now, how they will get funding, whether they have the plans for expansion, if yes, how they will get funding, internal approval or any fundraising. We can look for block of assets. If block of fixed assets are increasing, this gives us the indications that company is the expansion mode. And we can look for investments in this company. Then segment report, we mentioned earlier, this is a very crucial report. We should look into segment report. This gives us a clear picture of which segment or which vertical of the company is doing well. And if we have a clarity, we will quickly analyze the impact of any news flash in the TV or anywhere. Then what will be the impact of those news in our company where we are wish to invest, or where we have invested, and we accordingly, this will help us in taking the decisions. Trend analysis, in the same company we should look for past 10 years return. 1 year return may go wrong picture, 1 or 2 year return may go wrong picture. We should look for last 10 years. I remember the company, I forgot the name. कंपनी ने काफी बढ़िया रिटर्न दिया था 1 और 2 साल में, because of some disruptions in the China, एंड जैसे ही वो डिस्ट्रप्शन खत्म हुआ, वो कंपनी की, बिकॉज वो जो 2 साल में कंपनी के वैल्यू जो जिन्होंने भी इन्वेस्ट किए थे, वो 2 या 3 गुना हो गए 1 या 2 साल में. The moment that disruptions finished or goes away, the prices of that company fall drastically. So the company which gave consistent return in the past 10 years, we should pick for the investment, rather than company which gave decent return or good return in the 2 years. Or we should look into this, whether these 2 years returns, whether the company would be able to maintain these returns in the future also. We should compare the company with its peer. Comparison only gives us the true pictures about the company. If their peers grow by 20% and your company is growing by 15%, say 10%, then there is something wrong with you, because because sector is same, both are doing the same businesses. One is growing by 20%, one is growing by 10%. Then what could be the problem? What are the issues? We should look into those issues. We get the true understanding when we compare with the peers. If we get the better company in the sector, we should look for the company which is better in like performance and undervalued. With peers, we should choose. We can choose that company. Standalone analysis is not enough. This will not give the clear idea of. We should analyze our companies along with all the peers. Then this is most important in any company. Before investing, you look for the shareholding patterns. Okay. Promoters holding present and past. Look for the past also, whether promoters has raised their shareholding. If yes, this will give you confidence. DII, HI, NI, insurance, mutual fund, what are their holding, whether they are increasing, lowering. Non-institutional investors, retail. In any good company, one feature is common. Holding or under this category, which is retail, is generally low. It would be around 5 to 10%. So in a company which is good, retails are holding 5 to 10%, and 90% of their shareholdings are with promoters, DII, HI, FII, HNI, all the big giants. The company which is not good, which is not sound, holding of retail investors would be around 50%. This also gives us the clear behavior of retail investors, and we can understand what wrong we are doing. Then last is share placed, whether promoter have placed any share. If yes, then what are the reasons why they have placed? Is there any financial problem in the company? We should all these questions we should have in bear in our mind. Then next analysis is management. If management is good, they should have a vision of growth, taking the companies to new heights. In those companies we should invest, and the companies where management are satisfied, हमको दूर से ही सलाम राम राम कर देना चाहिए उनको, because they are satisfied, they don't want to grow. And in those companies, if we invest, obviously your investment will also not grow. Then integrity is the main criteria, and to understand the integrity, we have only past data record. If company is doing, if balance sheet, like balance sheet is annual report is our Gita, if that is doing well year on year, we can say our management बढ़िया है, integrity ठीक है management. So all past record data, annual reports gives a lot, speaks aloud about the management. Then this is the most important, CAGR. What is CAGR? Compounded annual growth rate. ठीक है, जो कंपनी 15% बढ़ रही है, आप ये मान लो कि आपकी स्टॉक प्राइसेस भी 15% बढ़ेगी, जो 20% बढ़ रही है वो 20% बढ़ेगी. So you pick the company which have a better growth rate and which can maintain that growth rate for a longer duration. If these criteria is fulfilled, we should invest and stay and enjoy the ride. Then this is the valuation. Valuation again is very much subjective, but this valuation analysis will give us the fair part. It will give us the range, and in that range we can make our decision of investment, like price earning ratio or average price earning ratio. I think price earning ratio of individual year or trailing price earning ratio may misguide you. Better is we should have an average pricing earning ratio of 3 years, because there may be abnormal situations in the market, like which may either dent the your fundamental, or you can push the fundamental. So these are the abnormal period. We to avoid the abnormal period, we take the average price earning ratio. So for past 3 years, if you know the for past 3 years, we take the price earning ratio that will guide us that the same P ratio can be maintained or can be better for the future. Price to book, we should look at, these are the crucial. Debt equity ratio, higher the debt equity ratio, avoid. Lower the debt equity ratio, preferred. Return on capital employed, higher the better. Return on equity, higher the better. You can expect return on your investment equivalent to return on equity also. And this CAGR is important in revenue and profitability. Revenue top line और bottom line दोनों बढ़िया year on year growth देने चाहिए. CAGR बढ़िया होना चाहिए and should be maintainable. We know the price is what we pay. जो stock market में जो price reflect हो रहा है, that is the price, and we need to understand the value. If we know both, we know the price. If we know the value, then we are the best or better position to take the decisions. And asset may be good, however good it is, but it may not be good at a expensive price. So if company is good, pricing is very high, we can avoid that. Company is good, pricing is normal, reasonable, we can pick. And company is good, pricing is undervalued, this is best. So every time we should bear in mind price and value. Price we know, and value we should derive by following all the valuation process. We should bear in mind economy also. Like India में population काफी ज़्यादा है, and looking at the population, we can say we are it's a good consumption market. So in this market, any company probability of for companies doing well is better, good. And with this we are hearing India may become 5 trillion economy soon. Currently it is 5th largest economy. In the coming year it may reach to 3rd largest economy. Innovations are on like in defense, earlier we were importer, now we are exporter. If companies, if economy is growing, like in the coming time, we may become the 3rd largest economy. That means in everybody's pocket, there would be much money would be available to spare. So whatever for today's time luxury, in the coming time, this may be necessary. And in today's scenario, we can see practically earlier जो गाड़ियां बिकती थी, जो पैसेंजर व्हीकल्स, वो लोअर सेगमेंट में बिकती थी. जो मारुति कार है 5 लाख 6 लाख 7 लाख. टुडे द सेम कंपनी और अदर कंपनीज इन द ऑटो सेक्टर, दे आर सेलिंग व्हीकल्स ऑफ 20 lakhs अराउंड. तो जो पहले 5 लाख पे बिकती थी, जो आज 20 लाख वाली जो गाड़ी ज्यादा बिक रही है, जो पहले 20 लाख की गाड़ी लग्जरी थी, आज 20 लाख की गाड़ी आज नेसेसिटी में बन रही है. तो ये सब हो रहा है बिकॉज ऑफ द money power the people will get or getting in their hand because of the growth of the economy. This is the benefit they are getting. Then tax rate is also very low in Asia and in India, and this may attract more investment, more growth. And more growth means when the companies grows, economy grows, country grows, everybody grows automatically. Then these are the screener filters. Everybody should look into that nowadays. Details are very much easily available, and there are various analyses also are done by these software screeners. You can look into screeners.in, trendline.com. You can subscribe. You can put all the financial parameters. You can filters whatever companies comes into your parameters. You can further choose for the further analysis. These are the various websites available in the market. So we can say availability of information is not the problem now. We should build the habit of reading. As I said earlier, it's not much intelligence is needed. It's much discipline and much consistency is needed. And one important consistency is, which we require is reading. The more we read, we are in a better position. We would be in a better position to take our financial decisions. And these are available books also. We can go through it. And what are the challenges? Now, challenges are like investable fund is very much limited. Limited time. We all have a limited time, and understanding also limited because of lower reading. यदि पढ़ाई नहीं करते, read नहीं करते, तो understanding काफी कम. अब इसके solutions क्या है? Solutions is we should read, build up the habit of reading, even for 1 hour a day. Whatever process rules we design for ourselves, we should follow those process and be disciplined. And wherever required, take the advice of professionals. And if we cannot do all these things, rather than picking up stock, sell. It's always better to invest in the Nifty, or you can choose the mutual fund. That also gives a best return in the market. Thank you very much. With this, I'm ending my session. Hello, Abhilasha.
Hello. Yes, sir. Yes, sir. Sir, we have some questions from participants that how to identify multi-baggers.
Ma'am, we have discussed three analyses, three scenario where
Yes,
we
sir.
are saying wherever company is undervalued. ठीक है, मतलब कंपनी की जो प्राइसिंग है कम है और उसकी वैल्यूएशंस काफी ज्यादा है. We should pick those companies, and that is the best scenario to locate and invest. And as far as your question is how to pick the multi-bagger, nobody knows. If we keep investing in the companies, which is in the third scenario company means those companies are doing good, or any company is doing good. Important is we should tap those companies, invest, and stay invested for the longer period, as long as companies CAGR is good. If CAGR is going up 20% year on year, आप ये समझ लो कि आपका रिटर्न्स भी 20% year on year बढ़ने वाला है, और 20% year on year बढ़ने वाला है, तो एक टाइम पे वो मल्टीबैगर ही हो जाता है.
Yes, sir, definitely. Okay, so we have next question is whether retail investors are advised for entering into future and options or not.
According to me, absolutely not. इसमें future and options में major problem जो आती है versus cash investment. If we are doing investment in cash, say we have capital of 10 lakhs, we invest 10 lakhs. If we are going in future and options, we will take the exposure of against 10 lakhs, we will take exposure of 1 crore or 2 crore. And then we will not have, if we situation goes adverse against us, in their situations, we will not have a holding power. We will not have further capital to push in, because those situations may be good for investment. But as we have invested heavily in the earlier, we may not have that much opportunity to invest later. And later, what we will do, rather than investing, what we will do, we will have to exit. Because against 10 lakhs, we have taken exposure of 1 crore. And market has fallen. And according to me, at that point of time, we should put more money. Now, how will get money?
Yes, sir.
And instead of putting money, we will be forced to exit that particular situation.
Sir, we have one more question from Snehil said that I contribute 100% in BPF, that is 12% mandate plus 88% self contribution. Should I divert 50% of it in SIP? And given
Sorry, I
my
didn't
age
get.
is for, sir, he contribute 100% in BPF, that is 12% mandate plus 88% self contribution. So he wanted to know that should I contribute, divert 50% of it in SIP?
Yes, can.
Okay. Okay, sir. If you
SIP is
have,
always advisable.
okay, okay, sir. Thank you. Okay, sir, we are not getting more questions. So should we conclude?
Yes, ma'am. Thank you, ma'am, for the opportunity.
Thank you so much, sir. Our speakers, CA Nimish Maheshwari, Mohit Basev, CA Giriraj Bank, sir. On behalf of ICI, thankful to you for giving your precious time and sharing your knowledge with us. I would also like to thank CA Durgesh Kumar Kabra, sir, CA Rohit Robatia, sir, and all members of council for such a great session. And I also want to thank all the viewers and participants who joined us and kept their support till the end. Thank you so much.
Thank you, ma'am.
Thank you.